Yo, how's it going, guys? Second stream of the day. Once again, you guys already know the deal. We are running 2 streams every single day, or not every day. I'm not gonna lie to you guys. But most days, most days we're gonna be trying to run 2 streams a day, guys. So obviously this stream obviously gonna be more of a reviewing stream I can't even speak. We're gonna be reviewing today's market. Obviously, if you guys tuned into the stream a few hours ago, you guys know we actually ended up getting a pretty nice trade. I'm not gonna say a nice trade. We did get a green trade. It was a little bit tricky, and it was something, right? But we definitely made it work. All right, guys. So let me just go ahead and just put out here that I am streaming real quick. Let me just put it out really quick. Give me 1 second here. And let me just put it out here as well. 45.8. There we go. But yeah, guys, everyone tuning in, guys, welcome to the stream, guys. Welcome to the second stream. Welcome. I'm gonna go ahead and give everyone a few more minutes to kind of join up, get ready, and everything. And we're gonna be reviewing a few trades. Now, the main trade that I do want to review for today, guys, is mainly gonna be the trade that we ended up catching this morning. All right, I'm not gonna lie to you guys. I really do like although the trade wasn't all the best looking type of trade. Obviously, you guys saw we did kind of chop up past our entry. I personally want to say this trade was honestly a pretty good trade chart wise. Obviously, not volume wise, it was kind of a little bit choppy, but chart wise, I honestly really like this setup. So I'm gonna be breaking it down to you guys. I'm gonna show you guys what we did right and what we possibly could have done wrong. I personally don't think we did anything wrong behind this trade, which actually ended up playing out into our price target, but I don't know. I just need to see what caused this chop here. Obviously, it's kind of impossible to see what made the chop happen, but obviously there's no wrong in going back into the markets and kind of just reviewing what's going on. All right, PA was bad today. Yeah, dude, tell me about it. Now, looking at the markets right now, to be honest, we are low-key pumping and dumping, or dumping and pumping. For some reason, I'm not sure why we're all of a sudden just speak. Oh, Trump is speaking. That's right. Yeah, Trump was speaking at 3 p.m. EST today. So yeah, this volume is probably coming in due to Trump today. Let me see. Big D, don't stream on YouTube. Leave it only for the premium. Nah, bro. This is gonna be a reviewing stream, bro. It's not. We're not trading right now, bro. We're reviewing. Chop was happening all day, low key. I wouldn't say all day. I mean, the morning session. I mean, the first few minutes coming to market open was pretty good, in my opinion. But obviously, as we headed closer and closer into the lunch hour and PM session, obviously price was getting slower and slower. Right, so we ended up taking the trade around here. I ended up seeing a nice DOL sweep, which I'm going to be reviewing in full detail for you guys for today. And I want to be talking a little bit more about the website. All right, guys, which I have pulled up right over here. Now, yesterday, I tried doing a one-on-one mentorship with you guys with the website, right? I tried doing the one-on-one, reviewing you guys' journal and everything. Now, this is the first stream that we did ever, using the website, using the mentorship feature. Now, I was rewatching the stream yesterday, and I was looking to see exactly what I could upgrade. And we have a new update coming with the website. We have so many more things that we want to add. I was thinking, okay, what if we try adding a replay feature, right? I did talk to you guys about it on stream of like maybe a few weeks ago on how it was very expensive. But if I'm going to be investing into this website and I want it to be the next big thing with my business, I need to invest money into it. So I think we're going to be paying for some data. It's going to cost us a few $1,000s, but we're going to be paying for a few years of data so we can build in onto the website a built-in replay feature where you guys can review the trades in real time. Because, for example, if you guys use the trading view replay mode, it kind of sucks in my opinion. And look, as much as I love trading view and everything, bro, this thing, it does not help. Like, I want to see how the candle's moving every millisecond. It sucks. It literally sucks, right? And like I said, I love TradingView and I love everything it has to offer, but the replay mode for TradingView being a multi-billion-dollar company, dude, they have to work on this. You know what I mean? So instead of waiting on them to potentially never even do this feature, why not just take matters into my own hands, pay for my own data, and build my own replay feature inside of the website, which is we're already trying to do it in the backtesting mode, right? So me and my friend, or my friend and I with proper grammar, we're gonna start working on this, and we're actually working on some new P&L stuff that I do want to show you guys on stream, but we're not gonna leak it just yet. Just know that we have a lot of stuff coming around. All right. So yeah, we're gonna be working on the data feature. where you guys can back test and in like every millisecond, like every little tick in every, in the markets, we're gonna download that data and put it onto the website. And then I'm not gonna lie to you guys. Yesterday I was journaling my trades, and to be honest, I do like the way that the journal looks right now, but I feel like it's kind of like there's too much happening. Like once again, here everything looks really organized, but I feel like there's too much happening and there's also not enough data at the same time. So I'm gonna try to fix this on my own. Um, so I'm gonna see how I do it. I already have a vision in mind, but for this weekend, guys, because what we're trying to do is we're trying to do an update every single weekend, so you guys have new content to look forward to every single week. So for this weekend, I'm gonna try to rework the UI on the journal tab. Once again, I feel like it's really good and it's very very helpful and everything, but I feel like there could be so much more. Like I feel like I can make it so much better. So yes, so right now, guys, oh, and by the way, we are currently right now as we speak. My friend is on the development page. We officially partnered up with Tradeovate. We already signed all the documents. We already signed all the paperwork. We signed everything, guys. And now going forward, hopefully for this weekend, guys, what we're gonna be doing with the Tradeovate partnership is we're currently building a built-in Tradeovate login. Once again, it's gonna be an authorized one. Tradeovate themselves checked out everything and they approved of it. So don't worry, don't think that you guys are gonna be giving us any data and we're gonna keep your accounts. Not at all. Right? We're gonna be doing an OAuth type of sign-in where when you guys want to automate your trades into the journal, right? Which means anytime you guys take a trade or a scale or an exit or an entry or whatever, it would Tradeovate is going to send that data over to the journaling website into your account, and every time you open up the journaling website, all of your trades that you took will be automatically inputted. All right, because yeah, we're why not automate it, right? It'll be so much easier, right? So we're also working on that, guys. Once again, it's gonna be a very straightforward, very safe, very secure type of thing where you guys obviously click link Tradeovate is gonna send you to the Tradeovate website. You log in using your Apex details. Once again, we don't keep that, and I don't want your details either, right? So once you log in, any and every trade that you take, all that data will be sent on over to the journal tab. And once you guys open up the journal tab so you can journal your trades, it's automatically all going to be inputted as to what trade you took, whether it's long or short, what time you took it at, the session, and so much more, guys. It's going to make it so much easier. All right, guys. But yeah, once again, the good thing about me doing these daily streams with you guys, not only to review our trades and actually learn and improve, but it also allows me to really see a very in-depth type of thing with this website, so I can fix it up and build it to where I'm happy with it, and actually I can actually teach you guys, and you guys can teach yourself with your own data and back testing. All right, guys. So I'm very very excited for this. So yeah. Anyways, let's get this started. No more yapping. All right, guys. So the whole point of the stream, guys, I'm gonna lay off the one-on-one mentorships for now, or no, I'm gonna do them. I'm gonna do them in today's stream, but it's not gonna be my main focus because once again, the mentor mode is ready, but since it's such a new update, I feel like there's a few things that I do want to fix before I do this every single day with you guys on live. All right. So what we're gonna be doing instead today is we're gonna be doing the one-on-one mentorships, and if you guys want me to mentor you, send me your mentor code so I can paste it onto my journal so I can see your journal, right? But what I do want to prioritize today is actually the journal from, or I mean, not the journal, the trade that we ended up taking today. Like I said, I personally feel like even though this trade was a little bit of a pain in the ass, I'm sure we can all agree, right? Bro, this dude said, Kevin said, yeah, bro, stop ranting. All right, bro. Anyways, here, hold on. Let me just kind of put this stream up here on my YouTube real quick. There we go. But yeah, anyways, so wait, hold on. Let me see something real quick. All right, perfect. Anyways, so yes, with today's trade, guys, I really, really, really want to review this. Like I said, I really believe that this trade was a good setup. It's just the market volume was so bad. Obviously, that's not something we can really blame ourselves for. That's just how the market was moving today, and we don't have any control of that. But I do believe that this trade was really, really good. So I at least want to break it down and see if I could have done anything better, and all that stuff. Now, I did tell you guys this morning that if we did end up taking this trade, it was gonna be a risky one. All right. Someone say here, the stop loss that you chose today saved my trade. Dude, mine too, bro. So yeah, let's get straight into it. All right, bro. So first things first, before we go ahead and open up the charts, or actually, let me open up the charts. Let me actually organize myself real quick. Let me just get this going real quick. Once again, I'm gonna be reviewing this trade in full detail, guys. So be ready for a very educational stream and get your notes ready, guys, because we're gonna be reviewing a lot of things today. I'm gonna be showing you guys SMTs. I'm gonna be showing you guys market structure shift, how to find them on the 1 minute, the 5 minute, why we need them, and so much more. All right, guys. Like I said, although today's trade was a little bit of a pain in the ass, it was still a winning trade, and there's a lot of lessons to learn from this trade. All right, so let's get straight into it. All right, guys. So first things first, what we're going to be doing, guys, is we're going to be going on and actually opening up our journal, because the first thing that we need to input into our journal, guys, is actually what trade we ended up taking, right? This will obviously organize everything, and once we input all of our data, then we start journaling the actual trade, and I will actually start teaching you guys. So this part will be fairly quick. Don't worry about it, guys. It won't be boring or anything, right? So obviously we ended up taking this trade today. As you guys can see over here on my Discord, we actually ended up alerting NQ shorts at 29,211. This was my entry for shorts. All right, so what we're gonna be doing here is obviously we took the trade today. We took this on MNQ, the direction we ended up taking shorts, and we took this trade in the morning session at 10:15 in the morning to be exact. Right, so obviously everything here is all correct. Now we ended up entering this trade once again at 10:15 in the morning, and we actually ended up getting out of this trade at 10:42 in the morning. All right. Now, for as far as our entries go, we actually ended up entering at 29,211. Our stop loss was placed at 29,284, and our price target was placed at a little bit of a bad risk reward, not gonna lie. But I will explain why I actually ended up taking profits sooner than I wanted to, or not really sooner. We did hit the price target, but it will make sense in a second, right? So our price target was placed, or our first PT was placed at 29,000. Oh, oh shit. Wait, the stop loss was placed at 284, and then 29,000. 172. So yeah, not the best risk reward, and I'll explain exactly why I did it like this, guys. So yeah. All right. So anyways, let me just make sure everything here looks good. The fees, everything looks good. Blah 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 blah. We took an IPG trade. Actually, no. Let me not do this. Because I want to journal the trade first. All right. So yes. Now a big thing that I noticed with today's trade was a lot of people were a little bit more disappointed with the price target. All right, and I'm gonna explain why I did what I did and why I took profits a little bit sooner than what I wanted on the first screenshot. All right, now I'm gonna break it down literally right now because I need you guys to actually understand this. All right, so here's the thing. All right, VWAP. Right, when we're taking reversal trades, right, one of our first price targets should always be the VWAP, especially when it's nearby. All right. So when we looked at this trade this morning, right, our first price target was actually at a 1-to-1 risk reward for about 65 points, right, which is the VWAP right over here at 29,000, near the 153 area, which is where our drawn liquidity was also sitting at. All right, so yeah, 153, 160, right? That's where I was looking to take profits. Here's the thing that you guys need to understand. When we are targeting the VWAP, right? When we take a trade and the market actually starts chopping up, what ends up happening is the VWAP ends up averaging out to where the price is at the moment. So when you're looking at this trade right here, right, our risk to reward at the moment, or when we entered the trade, was looking like a solid 1-to-1 risk to reward, right? Well, depending on the stop loss, I was going to use the 267 stop loss, right? But the thing is, as the market ended up chopping out, look, we ended up entering right here. We chopped for not only 5, 10, 15, 20, 25, almost 30 minutes. And obviously, in those 30 minutes, what ended up happening is obviously the VWAP ended up averaging up, right? Obviously, lowering our risk to reward as the time went on, right? So obviously that, this happens in every stream. People always say like, yo, like your risk to reward. Obviously, I always say, I'm a scalper. It's how I trade. It's how I've traded for the last 6 years. But I do agree with some people with today's trade, right? It was a little bit, we're still green on it, but I am a little bit disappointed with that risk reward because once again, at first when we entered, this setup looked amazing, right? And I still agree the setup was amazing, right? But obviously, unfortunately, we did end up getting chopped out a little bit behind the trade, making the VWAP end up averaging out. Now, someone here in the chat is asking, hi, David, are you going to be doing a question round later? No, bro. If you want, just ask me a question right now, bro. I have the chat open. As I'm reviewing the trade, I always take a second to check the chat out. If you guys have a question, I'll go ahead and answer it. All right, but so yeah, bro, if you have a question, go ahead. Now, someone say here, Jacquees Norwood actually ended up asking, can you explain why your stop loss reasoning? Can you explain your stop loss reasoning lately and why it hasn't been the normal 35 points? Now, if you guys are OGs, you guys may know that my usual stop loss back in the day, like a year ago, a year or so ago, whatever, used to be 20 to 30, maybe 35 points on a very volatile day. But now my stop loss averages out to be 50 to 65 points per trade. Why exactly have I been trading like this? Well, I actually answered this question yesterday, and what my answer to this was I don't want my stop losses to be this big, but I have to use them to be. I need them to be big. Why exactly? Well, guys, if you guys are my OG viewers and you guys have been trading for me with me for years, then you guys know that the markets have not been the same as what they were before. Back then, which is probably when you guys met me or found out about me, right? You guys know that we were trading during the Biden markets. We all know Sleepy Joe, he doesn't do anything, right? So obviously the markets were very plain, very boring, very, like even getting 40 points in a market back when Joe Biden was in office was insanely lucky. Like there would be days where we would barely even get 30-point candles, let alone 40. Now, ever since Trump came into office, obviously you know how Trump is with the economy, with war, with tariffs, and all that good stuff. Obviously, that sparks so much more volume in the markets. And here's the problem: the more volume we have, the bigger the stop loss we need, because now we need to adapt to the current market, right? So once again, back then, when I'm going to say when Sleepy Joe was in office, right, the markets were very slow, very plain, very boring, right? Which allowed us to use very, very small stop losses and still be doing very, very good with them. But now if you're using a 25, 30, 35 point stop loss, you're going to get stopped out before you can even click the buy button because the market is just so volatile, right? So like I said, I don't want to be using these big stop losses like 50, 60, 65 points, but I need to, because we need to adapt to this market. We need to adapt to how the candles are moving on an average point base, right? Which obviously, if you're looking at each and every single one of these candles, each candle is minimum 50 points, right? So obviously, if you're using a 30, 35 point stop loss, you're going to get stopped out with any little pullback. And that's the problem. All right, bro. So yes, to answer your question, bro, as much as I would love to go back to the days where, we were trading 25, 30, 35 point stop losses, unfortunately, that is not what this market has come to at the moment. We cannot work with that now, right? So yeah, it's like we just need to adapt. Now, obviously, if Trump ever comes down or he gets away from office or whatever, right, then sure, the markets may slow down. But at the moment, we need to trade with what we have in front of our face, which unfortunately is a bigger stop loss than what it was back in the days. All right, bro. So yeah. Anyways, they've changed hella. Dude, tell me about it, bro. Anyways, someone said here, Bobby G ended up asking. Wait, let me see if I have any other questions. Oh, wait, right here, right here. Actually, before I answer Bobby's, hold on one sec. So, Wizard is asking, if a trade goes into a chop, is it smart to get out of the trade as soon as possible or not? Because for this trade, it would be bad, I think. No, in my opinion, okay, look, when you enter a trade, right here, look, let me show you. When you enter a trade, there's two things that can happen. Either you hit the price target, you hit the price target, or you hit the stop loss. There's no in between. Now, if you're a little bit new to the markets and maybe you're a little bit more emotional and you don't have your emotions in check or none of that stuff, then yes, when you see chop, you could freak out because the trade is so indecisive. The trade is so up and down, right? You're going to see your P&L go green, then go red, then go green. Hey, how's it going, Gata? How's it going? But yeah, you're going to be seeing your P&L go green, then red, the green, the red, the green, the red, then one big pullback, and then back green. You know what I mean? When new traders see chop, they start freaking out because they're not used to seeing price move so volatile and so indecisive, right? But the way I like to think about it is the second you enter a trade, whatever happens is all noise, right? So look, when you enter a trade, your plan is either take profits up here or get out down here. If the trade does this, where you enter here and it does this, everything here is noise. Try your absolute best to stay calm and ignore the noise, right? All we're doing is either taking profits here or getting out here. There's no in between. All right, bro. So yes, when you see chop, I would not suggest getting out as soon as possible. Now, obviously, if you don't feel comfortable with the trade and you feel like you oversized or you just don't like the trade, there's nothing wrong with getting out. But if you're only getting out because the market is chopping, just give it time, right? Not every trade is bound to work out instantly. Not every trade is bound to go green instantly. In fact, let me show you something, right? Which is actually pretty embarrassing for some people that actually follow alerts, right? I like to call these the alert bots, right? Because once again, they never hold themselves accountable and they're the most emotional traders that you can possibly deal with, which is very annoying, right? But, I have to ignore it, right? But let me show you guys, right? So today, with today's trade, obviously, you guys saw we ended up entering NQ shorts. And yes, for some time, the market pulled back. It got close to our stop loss and everything. But remember, guys, most of the times, I'm not just pulling out a number out of my butt to give you guys a stop loss. Anytime I give you guys a stop loss, it has a reason behind that stop loss. For example, today's stop loss was placed at a level of liquidity. All right. So yes, sometimes when the market pulls back, for example, when we enter, we're not invincible to not seeing red on the trade for some time. It's normal. It's how the market works. It's all probability at the end of the day. Right? And let me show you guys something, right? So for today's trade, right, obviously we all saw the market actually ended up pulling back near our stop loss. It didn't stop us out, but it got close to the stop loss, right? That is known as a pullback. I told you guys literally before we entered, hey, this trade is going to be riskier because we still need to form the MSS model. So expect somewhat of a bounce before we go lower, right? And that's exactly what happened, right? As you guys see right over here, right? We got a little bit of a pullback, right? So look, we entered here. We got the pullback. We formed the MSS, which is what I told you guys we needed, and then we went back down into our price target. This was literally part of the plan. I literally told you guys to size light for this, right? And then you have traders that, when the trade sees barely any red, they start freaking out and they start putting little poop emojis, right? Which is funny. I find it funny. I don't really find it, like I don't really get hurt by it. I don't really care, right? But this is what I mean. Like if the market starts chopping up and you feel like you're not in the place to be holding it, then sure, get out. Right? But try not to be emotional. Once again, when you're entering a trade, your job is to set a price target and a stop loss. If your stop loss doesn't get hit, just because the trade is red does not mean you have to get out. Once again, you always need to make sure you have a plan before you enter. Your plan is your stop loss. Your plan is your entry point. Your plan is your price target. This plan, when the trade gets hit, you know exactly what to do in that area. So when the trade goes red for some time or whatever, and it hasn't hit your stop loss, you're okay, bro. The plan is still playing out, right? Because your stop loss has not been hit, right? So obviously, when you see these, it's very funny. I find it funny. Like I said, I've been there, done that. We've all been there, right? But yeah, bro, just try not to be this guy. You know what I mean? Where people see a little bit of a pullback and they instantly assume that the worst of the worst, that the trade is done and the strategy is patched and the strategy doesn't work and all that stuff. Like I said, guys, if you tune into today's stream, I did tell you guys, we are entering a 5-minute fair value gap inverse, but we have a 15-minute and we don't have an MSS model. So there is a good chance where the market pulls back before we see lower. We saw that, and then we saw lower into our price target, which I'm going to be reviewing in just a second. For now, I'm just answering questions. All right. But yeah, hopefully this answers your question. But once again, have a plan before you enter the trade. Know where you're going to enter, know where you're going to take profits, and know where you're going to get out if you enter the trade. If the trade goes down close to your stop loss, if your stop loss hasn't been hit, it's simply just noise. All right, bro, it's not that big of a deal. And if you get stopped out, boo-hoo, so be it. Move on to the next trade. All right, we're all grown people here. We're not here to complain. In fact, if you do complain, no one cares. All you're doing is making yourself look bad. You're making yourself look like a big fat baby, right? So yeah, bro, we got to keep pushing. All right, bro. So yes, if you don't get stopped out, anything that happens in the trade is simply just noise. All right, bro, as simple as that. All right. Yeah, let me delete this. Anyways, before I review this trade, let me keep catching up with the questions here. All right, let me see what we got here. So Jaquez is asking, okay, makes sense. So it's more of what the market is giving in the morning on the average candle size and put stops at the levels. Exactly. Once again, I really do wish we can go back to the 30-point, 35-point stop loss days. But once again, we need to adapt to the current market, right? If the market is telling us, hey, you need a 100-point stop loss, we need to use a 100-point stop loss. Obviously, there are ways to work around it. How? Just size less. It's pretty common sense, right? Because then you have the same people saying, oh my gosh, David, that's an 80-point stop loss. That's so big. And then there's the same people sizing 20 micros when their accounts can barely go down 20 points, let alone 80, right? It's common sense. Obviously, not many people have it in the trading space because, once again, you guys have seen the YouTube chats when we're live trading, right? But once again, like I said, if you have a brain and you can think correctly and you can do some common sense math, right? If we have a big stop loss, just size less. All right, bro? It's not that hard. All right, even I do it. You know what I mean? Anyways, someone said, KW ended up saying here, with this trade, I personally took small profits when we came down because of the chop and the drawdown. That was my emotions playing with me. Once again, if you feel like your emotions are playing with you, one big key thing that I've noticed when I'm mentoring a lot of traders is their sizing. A lot of people are way too attached to their accounts. And what happens when you're too attached to your accounts? Well, any little move and you're like, oh my gosh, the world's ending. Oh my gosh, let me get out. No. So the best way to manage your emotions and to actually start managing your emotions is size an amount that you don't care to lose. For example, let me ask you guys, what would you care more to lose, with 1 micro or 10 micros? Obviously, the answer is going to be 10 micros because you're going to be taking a bigger loss. So your job to really get those emotions all numbed out in the trading in the markets is size with an amount you don't care about. For example, for me, you guys don't see me freaking out when I take a 5 micro loss. I'm like, oh my God, guys, this is your fault, bro. You guys told me to take this trade. Oh my God, it's your. No, I say, okay, let me see what I did wrong. Okay, I lost this amount of money. I'm going to fix what I did wrong and I'm going to trade, I'm going to take the next trade without the mistake. You don't see me crying. You don't see me babying about it. I mean, so yes, once again, the best way to handle your emotions, KW, to not get out early or anything, to size an amount that you just don't care about. At the end of the day, if the trade works out, whether you're trading 1 micro, 2 micros, 5, 10, 15, 20, you're still going to be making money at the end of the day. All right, so once again, the best way to handle your emotions is simply just size an amount that you don't care about. This will help you kind of ease off the attachment to your funded account or your live account, whatever it is, right? So yeah, now someone here is saying, David, what is the difference between the legacy accounts and the end of day accounts? Now, good question. Now, for those that don't know, guys, Apex not too long, like a few hours ago, actually ended up releasing the legacy accounts back, which pretty much means that all of the old rules with the previous accounts, like way back in the days, are all back for a limited time. So if you guys do want to get some, the code is on the screen. It is called Blastoise. They're not only 90% off, but it is back to the old rules. Now, what is the difference between these accounts and why do I actually like them more? Well, for those that don't know, I'm always saying on stream, I personally trade on my legacy accounts, right? I've always traded on them, right? I feel like they're a lot better because one main thing is that there's no daily drawdown, right? Which is, in my opinion, very annoying, right? Another thing that you could do is the 6 payout rules is gone. The consistency rule is a lot better. What else? There's another key feature. Oh yeah, you have more drawdown on the accounts. In my opinion, the legacy accounts are overall just much better. So if you guys do want to get some, it is called Blastoise. It is on top of the screen, and these are the prices using the discount. All right, the discount code was called Blastoise. All right, so if you guys want to give them a try or a shot or whatever, use code Blastoise and try them out. Maybe the rules, maybe you like them a lot better. All right, guys. But yeah, anyways, next question. Let me see what we got here before we move on to the review here. Now someone here is saying, I need to watch your videos. I am confused about the MSS model. If you want Vinny, don't worry, bro. I'm gonna be reviewing it in today's stream. All right, bro. Let me see. They're not gonna make it in trading. Yeah, dude, trust me, bro. I've been doing this for 6 years, dude. I promise you, one little comment, I've seen it all, bro. I deal with this every day. You know what I mean? I just find it funny at the end of the day. I try to help them, but some people just, what is the saying? You can lead a horse to water, but you can't, you can't force it to drink it. That's how it is, bro. You know what I mean? So yeah, there's the same people tuning into the stream every single day, typing the same little message that everyone pretty much ignores, and they just keep doing it. You know what I mean? So yeah, at least I'm here. We're here making money. I'm trying to help everyone in here out as much as I can. All right, guys. Anyways, let's see. Las Gatas ended up saying Mark Douglas says that think like the casino. Losing is part of their business. It's the winning percent, not the daily win or losses. Exactly. I absolutely love that message. All right, so thank you for that. All right. Let me see. Wizard ended up saying here, okay, thank you. And by the way, I ended up passing my eval with this trade today, so thank you a lot. Bro, I'm so glad, bro. Now we got to get the payout for you. All right, bro? I'm really glad for you, bro. I'm really happy for you, man. Good shit, dude. Let me see. M2 Spooky is saying, me too, Vinny. I haven't used an MSS in a while. I had to look at his videos. Super helpful. I can link you guys some videos, but don't worry. I'm going to be breaking it down in today's stream, so don't worry about it. Now, Legna is saying, do you only consider fair value gaps or only IFEGs? No, I also consider fair value gaps. Now, I will admit, I don't use fair value gaps as often as inverses, but that does not mean I don't use them. In fact, I love regular fair value gaps, but I will say inverses are just more likely to happen with my model and what I look for in the markets. All right. Oh shit, no 6 payout rules? Nope. It's legacy accounts, but it's do we only have 1 month to pass? Nope. You have as much time as you want. Now, I don't really think it should take you any more than a month to pass an eval. It shouldn't really even take you any more than 2 weeks, in my opinion, even with light sizing. But if it does take you a month, there's no time limit. You know what I mean? Like, you'll be fine. They won't take away that counts or anything. You'll be good. All right. Anyways, I'm finally caught up with the chat. So let's get into reviewing the trades. All right, guys? So once again, the trade that we're going to be reviewing today. Oh, wait. One more question. Sorry if you answer this. Is the legacy activation fee paid for? No. I think it's included with the legacy accounts. I think. I'm pretty sure it is. Yeah. Anyways, let's get to the review. So guys, once again, the trade that we're going to be reviewing today is going to be the one that we took this morning. Once again, it's the one that played out for over 40 points. I know it's nothing crazy in terms of points and it's nothing exciting, but I promise you guys, this trade has so many lessons to learn. All right, even myself, I'm going to be learning a thing or two while I review this trade. All right, guys, so let's get straight into it. All right, guys. So once again, the trade that we ended up taking today was NQ shorts. As you guys see over here, it was an IFVG model. All right, so we're going to be going over to my journaling website, which is where we're going to be journaling down the trade. And obviously right here, since I already inputted all the date that I took this trade, which was today, MNQ, we took shorts, we took this in the morning. We took this entry at 10:15 and we got out of this trade at 10:42. It was a 30-minute long trade, a very long and stressful 30 minutes, I will say. We ended up entering this trade at 29,211. We ended up placing our stop loss at 29,284, and we ended up taking full profits at 29,172. And I ended up taking 5 micros with this trade. All right, with this trade, I ended up saying that I was going to size lighter because it was a little bit riskier, which I will be reviewing in full detail as to why I sized lighter on this trade. All right, now, if you look at the risk reward behind this trade, you might be wondering, David, this trade was terrible. The risk reward is horrible, right? Why are you saying this was a good trade? Now, two things. The trade was supposed to be a one-to-one risk reward. I didn't think the market was going to chop so hard at our entry to the point where our VWAP, which is going to be our first price target, ended up averaging higher up as time went on. All right, so where I was going to take profits for a one-to-one, I ended up taking profits for a 0.5. Now, does this make the trade automatically bad? No. You guys fell for the propaganda saying that any trade below one-to-one risk reward is automatically labeled bad. I disagree with that, especially if you're a scalper. If you're a scalper, you get in and out of the markets really quick for a little amount of points. All right. So I'm going to be breaking down this trade in full detail in just a second. All right, guys. Now, with this setup, we ended up taking an IFEG model. As you guys see from my screenshot right over here, yes, we ended up taking an inverse value gap model from the 5-minute time frame. So in order to start journaling this trade, we ended up using, once again, the IFEG model. All right. And by the way, if you guys need a copy and paste for all of this, it's all inside of my Discord. If you guys do want to join it, let me just invite you guys. It's completely free. All right, guys, let me just invite you here. It's all going to be in the trading chat. All right, guys. So we're going to be to get straight into this review, where I'm gonna go ahead and open up a blank chart, which is gonna be obviously the M&Q chart. With this M&Q chart, I'm gonna be showing you guys everything you need to know on how I found my drawn liquidities, how I found my bias, why I thought the market was gonna go lower, and how exactly we caught this reversal. All right, guys. So to get started, obviously, if you guys joined into yesterday's stream, you guys may know that I showed you guys how I find my levels of liquidities for myself. Obviously, there are a million ways to find levels of liquidities, but I feel like my way is a very simple way. All right, so let me show you guys. Right, so what I'm gonna be doing, guys, already, what I already did is I'm already on the replay feature, right, or the replay mode, and I went ahead and opened up the candle before we went ahead and opened this morning, right? So I can show you guys the freshest level on how I found them this morning, step by step. All right, so the first thing that I always do coming into market open every single day, guys, every single night, every single morning, no matter what, is I always make sure all of my levels are all marked out perfectly. Right, so what's the best way to go about marking out your levels of liquidity? What time frame should I use? What highs and lows should I use? Right, is there a specific thing that I should be marking out? It's very, very simple. All right, don't overcomplicate it. All right, so now here's the thing, right? I always tell you guys this. The lower the time frame, the more detail you see in the price action. You see more candles, you see more highs, you see more lows, you see more everything, right? But the higher the time frame, the less the candles. So check this out. I'm going to start off on the 1 minute time frame, right? On the 1 minute time frame, we have quite a bit of candles. By quite a bit, I mean a lot of candles. If you go over to the 5 minute, a little bit less, but there's still a lot of candles. You go to the 15 minute, a little bit less candles, right? A little bit cleaner. Go to the 30 minute, a little bit less candles, and you go to the 1 hour, and finally it looks a lot cleaner, right? So all we're doing is we're filtering out the useless candles, and we're only using the very important candles. So the best way I go about marking out all of my levels of liquidities is always starting off on the higher time frame. Now, what time frame do I personally suggest? You might be wondering. Well, you could use the daily, you could use the 4 hour, but in my opinion, I don't like the 4 hour nor the daily. I feel like there's way too little candles. I want to find the perfect spot, right? I want to balance it out to the point where I get a clean chart, but enough candles so I know where to mark up my highs and lows perfectly. All right. So looking at the chart, for me, I always suggest to you guys, do you think you could add Apple Pay to Critic? It's there. Yes, it is there, Trader Unknown. So once again, guys, if you guys do want to get access to the website, once again, here, let me just add it. I completely forgot to add it here in the chat. Because we're gonna be using the website for today's stream, or for today's review. So yes, you can use Apple Pay. All right, there it is. All right, bro. So yeah. Anyways, so once again, if you guys were to ask me, hey, David, what was I gonna say? what time frame do you always mark out your levels of liquidities to get the best levels possible? I would always suggest starting off on the 1 hour time frame, then working your way down to the 30-minute, then the 15-minute, and then possibly even the 5-minute time frame. Thank you. I got you guys. And once again, guys, or I got you, Trader Unknown. Once again, if you guys do want to get access to the website, guys, there is a free 14-day trial where you guys can journal. I can review your trades and mentor you guys one-on-one. So if you guys do want to get access to it, once again, I went ahead and sent it in the chat and I pinned it. All right, guys. So yeah, get access to the free trial, guys. Check it out. If you like it, I can teach you, a few things with the trades. I can mentor you and so much more. And once again, guys, we have a lot more features coming through. All right. So sign up. It's free. All right, or at least for the next 14 days. All right, guys. But anyways, yeah. So once again, we are on the 1 hour time frame. So what we're gonna be doing for today, guys, is we're gonna be starting off on the highest point possible. Someone said, "What about the 5-second time frame?" I guess you can use the 5-second time frame, bro. Anyways, just make sure you're starting off from the 1 hour. All right. So yes. So looking at this chart right here, I'm going to be starting off with the swing high, pretty much the highest point that I can see in the chart at the moment. Obviously, there's a lot higher that we can mark out, but we're not going to be here all day. Obviously, the markets didn't pump up that much. So I'm going to be starting off with the swing high right up here. All right. Or actually, we can just start off up here. Right. So once again, so you might be wondering, okay, well, David, how do I find my highs and lows? It's very, very simple. All you need to do is simply just find the trend in the market, right? For example, right here, the trend is pretty bearish. How do we know that the trend is bearish? Well, we have the main high, lower high, lower high, lower high, lower high, lower high. You guys might notice that the pattern in the current market on the 1 hour time frame, right, before we come into market open today is pretty bearish, right? The market is constantly making new lows after every major pullback. So we have 30,094. Then we have one right here, which is going to be our next pullback. Then we have another one here. Then another one here. As you guys can see, I'm just marking out every lower high being created, right? And that's that. It's so easy to find levels of liquidity, guys. It's so simple. So look at this. All you're doing is you're going on the higher time frame and you're just marking out the main levels, just like this. So look, for example, right here we have a main high at 29,999.25. Then the market sold off, pulled back. You're gonna mark out the complete top at 29,796, and then we go back down. Then we pull back up right here. Although it doesn't look like a crazy pullback, it is a pullback. Why? Because the market sold off, pulled back, found the high, sold off, pulled back, found this high, sold off, and then obviously you can mark out some more levels here, but there's no point. Why? Because any level that we had here has already been taken out. For example, this one right here, it was a valid level of liquidity back in the day, right? But now, or back in the day, like Monday, literally 2 days ago, you know what I mean? But instead of marking out this one, you want to be marking out untapped levels of liquidities. Always, guys, never mark out a liquidity that has already been taken out, because chances are it's not going to get respected, not even one bit. All right, guys, so always make sure you guys are marking out your best untapped levels of liquidities. All right, like I said, the best way to go about it is always starting off on the higher time frame, so you can filter out the so many candles that you get, and you just get the cleanest candles possible. Now, I will tell you guys a little bit of a con. There are pros and cons to this. All right, so let me just mark out the nearby lows, which is pretty simple. You have this one, then you have this one, and that's pretty much it. And then you have this one, right? So the lows is pretty easy, right? Just these 3 lows, right? But here's the problem. All right, the higher the time frame, the less the candles. The less the candles, the cleaner the chart looks. But let's go back one step to less candles, right? Remember, guys, we need to understand the market in full detail. If we don't understand the market in full detail, we are going to be missing some key points, which could be very effective with our trading, especially if you're trading on the lower time frame, right? So although we did mark out all of our cleanest levels nearby on the 1 hour time frame, if you go down a few time frames, you guys will see that we are missing out on some levels of liquidities. For example, if you go down to the 30-minute time frame, you guys will see that we have a beautiful pullback right here before we actually go lower. But if you go on the 1 hour time frame, oh wait, no. That actually looks like a pretty good pullback. Okay, never mind. Sorry for that. But you get the point, right? So the higher the time frame, the more candles. I mean, the higher the time frame, the less the candles. The less the candles, the cleaner your chart looks. The cleaner your chart looks, obviously, the easier it is to find levels. But the cleaner it is, you are sacrificing one major thing, and that one major thing is finding the actual smaller candles, right? So once again, now that we found all of our levels of liquidities on the higher time frame, like the like the 1 hour time frame, now we can go down one time frame and see if we missed out on any little levels that we couldn't see on the 1 hour time frame, or at least it didn't look good enough. Right, so if we go from the 1 hour to the 30-minute, let's see if we could find some extra levels of liquidities that we couldn't find on the 1 hour time frame. All right, so let's see what we got here. Some say you're a blast. What about the 1 nanosecond time frame? Yo, that's actually the time frame that I trade on, bro. So yeah, that's a pretty good time frame, dude. Anyways, so let's see what we got here. Now, on the 30-minute, we do have some pullbacks here that we couldn't really see on the 1 hour time frame, but in my opinion, it doesn't look that strong on the 30-minute. So I'm going to hold off on marking out these highs up here for just one time frame. Now, let's see if we missed out on any of the lows right here. We have another one here which looks decent, but we don't know if it's that good until we go to the lower time frame. So we're going to hold off on this one as well. Now, do we have any other ones here? Actually, yes, we do. Right here. As you guys can see, the market ended up pumping up, pulling back, finding this low, and then pumping up even higher. So what is this? This is the main low, main high, higher low, higher high. I mean, no, wait. The main low, main high, higher low, higher high, right? So this is gonna be your higher low. I always get them confused, bro. Like lower highs, higher lows. I always get them confused. Anyways, but yeah, on the 30-minute time frame, if you go on the 1 hour, you can't really see that there's a pullback here. All it looks like is just a little wick, right? But the lower the time frame, for example, if you go on the 15-minute time frame, this looks like a way stronger pullback. As you guys see right here, we have a major pump, major pullback, and a major pump again, creating a new higher high, right? So you see what I mean? I always tell you guys, start off on the higher time frame so you build your base around the levels of liquidities, and then once you build your base, then you go down a time frame, find some extra levels, then you go down another time frame, find some extra levels that you might not have seen on the two higher time frames, and then you keep working your way down until you are satisfied with every nearby level of liquidity. All right, so once again, let's finish up on the 30-minute time frame here, right? Once again, we had a level here. To the downside, once again, there's not much action to really mark out here. So let's see if we have some more action to the upside, which, to be honest, doesn't look all that crazy. So now that we're done on the 1 hour and the 30-minute, let's work our way down to the 15-minute. Maybe there's some more action that we can mark out here, right? So now here, these candles start looking a little bit more interesting. Once again, if you look at the 1 hour time frame, there's no wicks here. It's just red, red, red with a few wicks. You know, pretty useless candles, right? Doesn't really tell us the story in the markets, right? But if you go to the 15-minute or the 5-minute time frame, you guys will see that these wicks actually do have some meaning in the markets, right? So what we could do here is mark out the complete top at 29,363.50 and mark out every pullback going lower, right? So we have one here, market dump down, pull back. We have one here, market dump down, pull back. Another one here, market dump down, pull back. Another one here. And the process goes on and on. So we dump down, pull back, another one right here. Then we dump down, pulled back, another one right here. And then we dump down, pulled back, another one right here. Right, I'm sure you guys are getting bored, like freaking annoyed of me saying another one here, but you get the point, right? There's a lot of levels of liquidity that we just couldn't find on the higher time frame. All right. So we went ahead and marked out all of our smaller time frame liquidities. Now, we already marked out the 1 hour. Wait. Let me make sure there's no lows here. Oh, look at that. Look at that. You see what I mean? We could have missed out on some levels here, right? So once again, we have the low right here at 700. We pumped up, pulled back. This is not going to be the strongest level in my opinion, but it definitely is a pullback. Then we pumped up, pulled back, found this low, and then we pumped up, and that's about it. Right now, you could mark out this level, but what I tell you guys, we're only looking to mark out untapped levels of liquidities, right? So although this one is strong, we've already tapped into it, so it's no longer important to us, right? We only want the freshest, cleanest, untapped levels of liquidities. All right, so now looking at the 15-minute time frame, not only the 15-minute, but the 30-minute and the 1 hour, we're pretty much done with everything here, right? We have everything marked out here, and we have everything marked out here. All right, so we're pretty much good to go. Right now, before we finish, let's double check the 5-minute, which looks like an absolute mess. So I don't even want to look at the 5-minute, to be honest. Yeah, we're pretty much good. Now, let me ask you guys in the chat, right? Let me start quizzing you guys a little bit. Now that we marked out every single time frame now that we marked out every drawn liquidity on every single time frame, let me know in the chat, guys. Do you guys think that we are now ready to go into market open? Yes or no? Let me see what you guys are thinking. All right, guys, I'll give you guys a few minutes. In the meantime, I'm going to drink some water. But let me know, guys. Now that we marked out all of our levels of liquidities, do you guys think that we are absolutely ready to come into market open? All right, let me know, guys. Let me know. There we go. I'm seeing a few good answers here. All right. So Corey, which welcome back. I saw you today in yesterday's stream as well. Corey is saying, no, we're missing fair value gaps. KW is saying, no, we are missing fair value gaps. Bounty Hunter is saying no. Wizard is saying no, we are missing fair value gaps. And M2 is saying not yet. We gotta see if there's any potential setups. And you guys are absolutely correct. All right, guys. Yes, you are absolutely correct. Because obviously there are days, like I've said, you know, I even said in yesterday's stream, there will be days where you're gonna find the setup literally 1 second into market open. right? Draw liquidity is needed too, right? Well, yes. What do you think we just marked out for the last 30 minutes? Yes, we have the draw liquidity, but here's where the confusion comes around, right? A lot of people think that once you have your drawn liquidities, you're ready to go in the markets. And they're partially right, right? Because yes, you do need drawn liquidities to actually know what the market is going to do, where the market is going to go to, what the bias is and everything, right? But what's a drawn liquidity and what's the point of having a bias if you don't know where you might want to enter? All right, so yes, the next best step that we need marked out before we come into market open is actually find where all of our fair value gaps are at. Now, we don't need to go on every time frame to find fair value gaps. Remember, guys. Excuse me, I have a few like hiccups. Remember, guys, fair value gaps acts as our entry model, right? So your job is only to find fair value gaps on time frames that you trade, right? So you don't need to go on the 4 hour, you don't need to go on the daily time frame, you don't need to go on the 1 hour, you don't need to go on the 30 minutes to find a fair value gap. Only find fair value gaps that you use on the time frames that you trade. For example, the 1 minute, the 5 minute, the 15 minute, and so on. Right? For me, I personally only trade the 5 and 15-minute time frame. So what I'm going to be doing is marking out my nearby fair value gaps on the higher time frame first, which will be the 15-minute, and then once I'm done marking out all of my nearby fair value gaps on the 15-minute time frame, then I am going to be marking them out on the 5-minute time frame. And then this will be the final step coming into market open. All right, so let's go ahead and see what we have here. All right, so looking at the market at the moment, right? Let's just imagine, right? It was today. It's morning time, right? The market hasn't opened yet, right? What nearby setups do we have here that we want to go ahead and trade? Someone say here, hey, bro, why not the 1 minute, bro? I don't know, bro, dude. I don't know what it is about the 1 minute, bro, but I hate trading the 1 minute, bro. There's so much happening, bro. It's too much, dude. I feel too overwhelmed. Right now, I'm not saying the 1 minute is bad. In fact, there are even traders out there that trade on the 30-second time frame. I just personally feel like it's just too much noise and there's too much happening. I need to calm down. So I like the 5 minute. It's not too much, but not too little. All right. So looking at the 15-minute time frame off the bat, we can already see that we have a pretty big candle here. Now, looks can be very deceiving. All right, especially with girls. And no, all jokes aside. Yes, looks can be very deceiving, right? So although this candle does look very, very big, right, we need to always double check and make sure that it is a valid fair value gap, or not a valid imbalance. Right now, how do we know if it's a valid imbalance? What are the rules that we need to know if a fair value gap is valid enough to mark out? All right, well, there's two rules. All right, rule number one, on NQ, right? On ES might be a little bit different, but on NQ, right? Someone say, wait, Lady Trades ended up asking here, do you mark out 1 hour liquidity levels before the 15-minute? Yes. I start off on the 1 hour, then I work my way down to the 30-minute, then I work my way down to the 15-minute, and then I work my way down to the 5-minute. Always start off on the higher time frame to find the best levels, and then work your way down. Because remember, the higher the time frame, the less the candles. The less the candles, the cleaner the chart. The cleaner the chart and the less the candles, the less data you see, the less levels you see. All right, so the 1 hour, you start off with the 1 hour, you mark out your base, right, which is pretty much just marking out the cleanest, strongest levels of liquidities, and then you work your way down and find the weaker or just smaller liquidities that are still pretty valid in the markets to go ahead and take. All right, so yes, I mark out my 1 hour before the 15-minute. Yes. Anyways, now looking at this candle right here, if you mark it from top to bottom, wait, before we do that, right? Rule number one, there are two rules into marking out a valid imbalance and a valid fair value gap. Rule number one is always make sure that at least on NQ, on the 1 minute, 5 minute, or 15-minute time frame, I'm gonna write it down for you guys. All right, so you guys can take a screenshot of it. FEG rules for NQ. Remember, we have ES. It's completely different. It's only for NQ. Rule number one: always make sure that the candle is 40 plus points. This is rule number one. Even if the candle is 39.75 points, you're not marking it out. We need it to be only minimum 40 points. The more the better, but minimum 40 points. Now you might be asking, David, why do you always say it's always 40 points, right? Is there a rule in the markets, like a rule book that says it's 40 points? No, a fair value gap can even be 30 points if you want it to be, right? But with my back testing of me trading my strategy for over 4 years now, right? I've always noticed that the more points a candle has, the more respected it is, right? And I've noticed that the bare minimum with all of my best trades, the bare minimum was always 40 points. So I always stuck to trading fair value gaps that are 40 plus points. Now, once again, just because a candle is 40 points does not mean it's a valid fair value gap. All right. In fact, no one knows this, right? We don't know what an imbalance is in the market. We don't know what what's enough volume to know what's an imbalance in the markets. What we do know with good back testing throughout years of data is the bigger the candle, the better the imbalance. The better the imbalance, the better the reaction from the fair value gap you will get. All right, so once again, with my personal back testing, with trading the strategy for every single day for over 4 years straight, I have always noticed that my best trades come from a minimum of 40 points in the imbalance. All right. Now, once again, if you want to mark out a 39-point candle, if you want to mark out a 35-point candle, by all means you can. But in my opinion, I feel like it's just not as probable as if you were to have a bigger candle. Right. So for me, with my personal trading rules, I always stick to 40+ point candles. Once again, you can do lower, but you just probably won't have the best probability and the best results behind your trades. Trust me, guys, I've tried 30-point fair value gaps. I tried 35-point fair value gaps. And for me, minimum 40 points has always worked flawlessly for me. I love 40+ point fair value gaps. All right, so once again, I don't have like a big rule book that just says you need to make sure that fair value gaps are only 40 points. No, this is just something that I've learned throughout my years of back testing. All right. Let me see. Someone say here, finding out your candle needs to be 40+ points got to be the best discovery. Literally, yeah. I learned it the hard way. Trust me, bro. I learned it the hard way. Thank you, David. These sessions are gold. Thank you. Once again, we don't have too many viewers in these streams, which to be honest, it's totally fine because I'm able to kind of interact in a more personal level with a lot of you guys. Because when you guys ask questions, I don't have like 30 million people asking me questions. It's literally a handful of you guys, which allows me to go in full detail because I know you guys are paying attention. All right. Let me see. Without the emotions and stress of trading, and trading time, now it's easier to learn and understand everything. I'm very glad it's starting to click for you, lady. I'm very, very glad for you. All right. So let me see. The candle is 40 points, not the fair value gap, right? Absolutely. Right. So okay. So before I go to rule number 2, yes, you are completely right, Vinny. Right. When you are marking out an imbalance, also known as a fair value gap in the market, the size of the gap itself does not matter. So for example, if you look at this candle right here, let's go based off rule number 1. Rule number 1, always make sure that the candle is 40+ points. So let's measure it, right? From top to bottom, right? This candle's over 96 points, literally more than double of the fair value gap size or the proper imbalance size. So best believe that this is a very valid fair value gap. All right, now you might be wondering, okay, well, David, if I mark out this fair value gap, right, like this, and I measure it, it is not 40 points. Does this mean that the fair value gap is still valid? Yes, because the size of the gap itself does not matter. What matters is there an imbalance in the markets? If there is, then you can make the strategy work. So once again, when you are marking out imbalances, which is just the size of the candle itself, the candle needs to be 40 points. The gap does not need to be 40 points. In fact, I've taken 100+ point trades off gaps that were literally 3 points in size. So yes, the size of the gaps do not matter. The size of the candle does matter. All right, so always make sure the candle is 40+ points. All right. Let me see. Hey, bro, I've been doing this for almost 3 years with this strategy, and I still tune in. You should never stop being a student. Bro, no one is a master in the markets. All right, bro? Trust me, just when you guys think you are you're like the best in the markets, that's when the markets humble you very bad. All right, bro? We're all always going to be a student to the game. Always. All right, even me, guys. A lot of you guys always look at me as someone, who you can follow and follow trades from. But keep in mind, guys, I'm human. I have emotions. I lose. Everyone loses, even banks. All right, guys. So yeah, bro, you're always gonna be a student to the game. Always. No one is ever good enough to not ever review trades, and no one is ever not good enough, or no one's ever good enough to just not be humble. You know what I mean? So yes, but you always gotta be humble. You know what I mean? Anyways, so Gustavo. It's usually Gustavo, but anyways, Gustavo was asking, "Hey, is all of this gonna show up on the trading view if we copy your account?" What do you mean copied my account? What do you mean copied my account? Like my link? Is this what you're asking? Like this right here? I mean, it could show up. Yeah, I mean, I can leave it to show up if you want. If anything, it'll be easier if I just send you screenshots, or you could just always watch the recording. This is all being recorded on YouTube. All right. Anyways, so Doug is asking, and you measure the candle plus the wicks? Yes. Now, very Doug Guyeva. Sorry if I'm mispronouncing it, bro. I'm for sure mispronouncing it. Anyways, so yes, this will actually your question leads me to rule number 2 of the fair value gaps. All right, now rule number 2. All right, always make sure that the body, the body of the candle is at least 70% of the candle. All right, what exactly does this mean? Well, guys, let me show you something. And I want to be asking you guys in the chat. All right, let me try to find the candle here. Let me see what we got here. Okay. Let me see. Okay. Okay. Look at this candle right here, guys. All right. Look at this where my mouse is. All right. If you guys have to zoom in on the stream, zoom in. All right. This candle right here, it's a 57-point candle, right? But look at the candle very closely. Is this a fair value gap? Yes or no, and why? All right. Do you guys think, once again, if you measure the candle from top to bottom, including wicks, it's a 57-point candle. Do you guys think this is a fair value gap? Yes or no, and why? Let me know if you guys understand, yes or no. All right. Now, in the meantime, let me catch up with the question. No, we're still missing fair value gaps, and we're going to mark it out into ES and clear the MSS better for a full body and little to no wicks, correct? Yes, correct. All right. Someone say here, or not someone, Brian Hernandez ended up saying this. Wait. Let me catch up with the question. All right. B58. Ooh, you're a beamer boy. So am I. Anyways, so I don't know if you said this, but if a gap gets tapped into multiple times, does it get weaker the more it gets tapped into? No, it does not. It actually gets more respected. So in my opinion, I will literally tell you this from backtesting sessions, and from actual trading, screen time trading sessions. When I'm live trading, I actually prefer trading fair value gaps that have been tapped into more times than I can count. Because what this shows me is that if price keeps bouncing or rejecting from a fair value gap, this shows me that this is where buyers or sellers start stepping in like crazy. All right. So yeah, I absolutely love trading fair value gaps that have multiple bounces or multiple rejections. This just shows me that this is a valid fair value gap and the market is respecting it. So if we're going back down into it again, best believe I'm gonna get a trade off of it always. All right, I love trading fair value gaps with taps, into it. So yes, that hopefully that answers your question. All right, let me see. Let me see. No, it's kind of a long-legged doji. Yes, you're absolutely correct. So if you guys said that, no, this is not a valid fair value gap, you're absolutely correct. Now, why is this not a valid fair value gap? Well, if you even try to mark out a fair value gap here, how the hell are you going to mark it out? There's nothing to mark out here, right? Now, on the other hand, right, remember, when you are marking out an imbalance, when you're finding and identifying an imbalance in the market, always make sure that the body, remember guys, a candle is made up of two things, the body and the wick. This little skinny line here is a wick. This big square or rectangle is a body. All right, so back to my rules. All right, when you are marking out a fair value gap, always make sure that the body of the candle makes up for at least 70% of the candle. So if you look at this candle right here that we are currently marking out as a fair value gap, right, and you mark it out from top to bottom, it is over 96 points, which goes with rule number one, right? And the rule number two, you might be like, oh, but David, we have wicks here, right? Doesn't this make the candle not a good candle? No, it actually does make it a good candle because these wicks, although there are wicks in the candle, they're not as big as the body of the candle, right? As long as majority of the candle is a body, it is a valid imbalance in the market because what this shows us is that this is the current active price. Wicks show us the history of the candle. The body shows us what the candle is actually doing. All right. So when you're finding fair value gaps, always make sure that you are marking out the body of the candle. All right, guys. So yeah, keep that in mind, guys. Very, very important rule. So yeah, when you're finding fair value gaps, there's only going to be two rules. Make sure the body of the candle, make sure the candle itself on the 1 minute, 5 minute, and the 15-minute time frame is over 40 points. Rule number two is always make sure that when you're marking out fair value gaps, don't just mark out any big candle that you're seeing. Make sure that the candle is majority of the candle is a body. If it is not a body, skip it. All right, because you're trading what you're trading what price once was. You're not trading what price is at the moment. You're trading what it was before. All right, remember, guys, wicks tell you the history. Body tells you what the active candle is doing. All right. So this right here would be your active imbalance. All right, because once again, if you had a wick here, how the hell are you going to mark out the fair value gap? All right, you need to make sure that you're marking out active price, which is where the body comes from. All right, guys. So yes, these are going to be the rules here. I'm going to go ahead and send it here on the YouTube chat so you guys can copy and paste it. All right, if you need it in your notes. All right, there you go. All right, anyways, let me just drink some water here. So back to our review. All right. Can you take a screenshot of the rules and send them in the Discord, pretty please? I have to go clock in. You're good, bro. I got you, bro. I got you. Let me send that real quick. What's your Discord so I can add you? Oh, it's Trace. I think I've seen your name around. Trace, right? Trace. Oh no. I think I've seen your name around. I just don't know where. Wait, Trace Trades? Yeah, right here. Trace, right here. Yeah. All right, I went ahead and sent to you. All right. Anyways, let's catch up with the chat here before we go deeper into the review. I'm guessing price comes back to replace and fill prices at a more efficient price to least auction wise. That's why price returns to the imbalance. Does that make sense? Okay. How do I explain this? Because the thing is, I need my face cam on. Hmm. Okay. Instead of me explaining it, I'm just gonna send you a video. Because I have a video specifically on fair value gaps, and dude, it is so. I even watched the video myself. I'm like, wow, I'm actually learning a lot for myself. But here, Brian, I'm gonna go ahead and send you the video, okay, bro? Just you know what, if you have some time tonight, you know, before you go to bed or whatever, check out the video and you should be good to go. All right, bro. This video will literally explain everything about a fair value gap, how imbalance works, how it's being created, how banks use it, you know, to take advantage of price and manipulate price, and so on and so forth. All right. Remember, it's a concept, but I use it and I feel like it works pretty well. All right. So I went ahead and sent you the video on that as well. All right, bro. Anyways, so once again, guys, our job before coming to market open today is to find all of our nearby fair value gaps. Remember, we haven't finished doing that just yet. All right, bet. Thank you. Yeah, man, I've been studying since 1 p.m. today, dude. I promise you, bro, that video right there will help you out so much, bro. Check it out. All right, obviously not now, but later on in the day. All right. Anyways, so yeah, once again, guys, looking at the 15-minute time frame, guys. So far, all we have marked out is this one 15-minute bearish value gap. Right, obviously, I'm sure we probably have more fair value gaps. So let's scout around the 15-minute before we go on to the 5-minute and before we actually go into market open. All right, so once again, we have a 15-minute here. Let's keep looking around to the upside. Let's see if we have any other fair value gaps. From the looks of it, there's nothing here, to be honest. All right, there's no imbalance here. Nothing. Okay, now to the downside. Do we have anything to the downside? Okay, let's see. Okay, so we had one here. We filled it. Nothing. Oh, look, right here. We have a fair value gap. Boom. Let's mark this out as the 15-minute bullish FEG. All right, let's work our way down. Nothing. We had one here, but we filled it. Oh, look, we have one right here. 15-minute bullish fair value gap. Right now, one thing I will tell you guys is if you guys don't want to do all of this manual work, I actually have an indicator that we coded ourselves that does our job for us. It finds all of your nearby levels of liquidities, all of the best ones, it labels them, and it finds all of your fair value gaps. All right, so if you guys do want access to this indicator, I can send it in the chat. It's not really something I promote, and in fact, not many people even know I have my own indicator. But this indicator tells you, just imagine me in your chart, right? It marks out your levels of liquidities. It tells you if the volume is good and worth trading. It marks out your fair value gaps, and it even tells you where to enter, place your stop loss, and even the price targets. All right, obviously it doesn't show it right now because the market is closed. But yeah, the indicator does everything. So if you guys want, look, I'll even show you guys. Look, you see how it marks it all out, right? And look, I have 0 drawings. I deleted them all. Right, so you see, look, London high, swept low, fair value gap here. So yeah, looking at the indicator, we were correct, right? We had a fair value gap here and we had a fair value gap here. Is there anything else nearby? Yeah, we marked out this one and we marked out this one. This one, you could mark it out. I wouldn't use it because it's already mainly filled. But you can mark out this one, you can mark out this one. And if I go undo everything, you guys will see that we already marked out all the fair value gaps. So once again, guys, if you guys do want to get access to the indicator, it literally does all the work for you. So if you don't want to be doing what I'm doing in the review right now, because I don't know, maybe you're lazy or something, it's all gonna be here. All right, it's all done automatically. All right, and like I said, it even tells you when you should be entering and exiting the trades. All right, I could probably show you guys a screenshot, but I gotta find it. Anyways, I'll turn that off for now because obviously you guys are here to learn. All right, we're not here to automate anything, although it is automated. All right, anyways. So yeah, looking at the 15-minute time frame with the nearby fair value gaps, you know, we found one here, 15-minute gap here, 15-minute gap here, and 15-minute bearish value gap here, and nothing else. Now, are we ready to come into market open? No, not yet. We're still missing the 5-minute time frame. So let's go into the 5-minute time frame and let's see if there are other fair value gaps that we can go ahead and use to mark out. Now, I'm not gonna lie to you guys, I don't feel like scouting around because we've already been streaming for an hour. So we're actually gonna have the indicator do all the work for us. You know, why not? It's automated. All right, in the meantime, I can catch up with the chat while it does all the work for us. All right, now someone say here, hey D, do you plan to make a streaming like this about prop firms? What do you mean about prop firms? Like, if you have questions about profit, if you want, you can ask them now. The stream is to help you guys out. Do you need premium for it, or is it a whole different purchase for the indicator? Now, if you're in the premium, I can just give you the code for it. Just DM me and be like, hey, I'm in the premium. You know, I would like to try out the indicator, and I'll send you the code. All right, bro. So yeah, if you want, just add me in the trading chat, and I'll send it over to you guys. All right. Yeah, I have an offer where I include it with the premium for like a month or 3 months. So if you guys want to try it out, like I said, it's completely automated. It gives you entries, it gives you exits, it gives you fair value gaps, drawn liquidities, trade ideas, and so much more. All right, just imagine me in your chart doing everything for you. That's how we did it. All right. Anyways, Wizard is saying here, since I passed my eval on the 25K account, is there any advice on how many micros I should be buying? Okay. Now, Wizard, before I move on, into actually, marking on the fair value, which was the indicator actually did for me. So let me just quickly do this real quick. In the meantime, Wizard, can you tell me what is your not what is your buffer? What is your drawdown on the account? Like how much drawdown, so I can do the math and tell you how much you should be risking. A 25K account has like what, like 1.5K drawdown, right? Yeah, like when is it? When is the best time to get a payout, etc. Like on a 50K account, dude. Look, prop firms, they're money making machines, bro. $1,000 on what? For real? It's $1,000? No shot. I thought it was 1.5K. All right, anyways, all right, whatever. But yeah, Soker One, I think that's your name. In my opinion, bro, look, prop firms, people always say, and they always say, like, yo, like, make as much money as you can on a prop firm before your questions, you get the max payout. I disagree with that. All right. What's it called? With prop firms, whenever you're eligible for a payout, request it. Always. The return on investment is always going to be positive. Whether it's a $500 payout, $1,000, $2,000, no matter what, request payouts anytime you're eligible. Now, the more payouts you request, obviously, depending on your sizing, you will always just slowly build up a buffer as time goes on. But your main job is always request as soon as possible. Trust me, bro, I've seen so many people where they can request a $1,500 payout and they're like, nah, bro, I want a $2,000 payout. Next day they blow their accounts. All right, bro. So yeah, is the indicator complimentary with the lifetime premium subscription? Yes, just DM me. I'll send it over to you guys. All right, or if you want, just yo, Aaron, yo, your car is sick, bro. What the heck? Yo, this guy DM me or said, or not this guy, Aaron. And I'm saying, yo, can you DM me the code for the indicator? Obviously, I'm gonna send it to him. But dude, your car is sick, dude. I love it, bro. It's like it gives off like Fast and Furious. Wait, that is Fast and Furious. Wait, no, it's not. That's sick, bro. I love it. Really nice car. Anyways, let me DM you the code real quick. Here. One second. Let me get my stream deck here because I already have it copied and paste. So indicator. There we go. All right. And then I think I got another ping here. Okay, there you go. Anyways, okay. So where were we at? What was I talking about again? Oh yeah, the drawdown. Okay, okay. So look, I'm gonna open up another tab for my website here. So I'm gonna go to futures calculator. Okay, so for my people in here using a wait, Quest Trade. Yo, can I get the code? I got you, bro. There you go. Anyways, so for my people in here using a 25K funded account with a $1,000 buffer, here's my way in sizing correctly with the trades. Now, who's the one that asked me about the 25K account? Wizard. Okay, Wizard, let me ask you, what do you think is your average points in stop loss? Like, how many points do you usually risk when you're trading? Like, is it 40 points, 50 points, 45 points? What do you think? All right, so I can give you the right contract size, and the right, formula. All right, let me know how much you risk, and anyone else can answer this if you guys want me to tell you how much you should be sizing based off your account and your drawdown. Let me know. Around 50 to 60. We'll do the middle, like 55. All right. Okay. So what we're going to be doing here is we're going to be opening up the calculator. All right. Now, with a $1,000 buffer, for me, all right, I feel like it's common sense that if you lose, in my opinion, 5 trades in a row, it's time to blow that account. It's time to let it go. All right. It's time to let it go. All right. So in my opinion, I feel like if you lose 5 trades in a row, your account is gone. If you lose 3 trades, your account should still be alive. If you lose 4, you're on the verge of blowing it, but it's still, you have redemption for one more trade. If you lose 5 losing trades in a row, it's time to give it up. All right. So if you have a $1,000 buffer or a $1,000 drawdown, you divide $1,000 by 5 losing trades. And this will give you a total number of $200 that you should be risking per trade. All right, so let's go into the next step. All right, wait, someone say here, David, can I get the code for the indicator? I got you, bro. There you go, bro. I got you. There you go. Anyways, so looking at M&Q here, right, on my website, you go to the futures calculator, right, everything here, click on micro futures and click on M&Q. So if you are on a 25K account and you need to be risking $200 per trade, if you lose 5 trades in a row, you blow the account. If you lose anything less, that account is still alive. All right, so you should be looking to risk maximum or around $200. All right, so let's see what we can do here. So if you're risking about 55 points per trade, right, let's say you're doing a 1-to-1, so 110 points, right? You should be, with one micro, you're risking $110. So if you were to ask me, when you're trading with a 50, 60, 55 point stop loss, you should be risking about 2 micros, in my opinion. Now, obviously, that this doesn't sound like much, but remember, bro, you're trading on a pretty small account, 25K, right? So I feel like it's a $220 per trade is pretty good. So yes, do like 2 micros, I would say. Now, if you're on a 50K, which is a lot more common, me and then a lot of you guys as well, we all use 50K accounts. You might be wondering, David, now that we're talking about risk reward, how much should I be sizing on my 50K accounts? Well, the way I go about it is, once again, you open it up right over here, right? 50K account, well, back in the days, they used to have a $2,500 drawdown, but now they have $2,000, right? So you do $2,000 divided by 5 losing trades. This will give you a $400 limit. All right, so you should be risking somewhere near $400 per trade. So in my opinion, what you do is you just go up with the 50. Remember, guys, obviously, the lower the stop loss, the more you could size. It's common sense. But if you're going to be doing like 50, 55, 60 points, you should be sizing on a 50K account, or on the 25K, do 2. On a 50K account, do 4. All right, because with 4, you're risking about $440. Now, obviously, it doesn't need to be exactly $400, but try to risk around this area. All right, because this just gives you more room to afford losing trades and obviously, hold more trades and take more trades and so on. All right, don't be that one guy that complains about the stop loss and you're the same person full pointing the trade. All right, bro. So yeah. So for 50K accounts, do like 4 to 5 micros, obviously depending on the stop loss. If the stop loss is 45 points, you can even do 5 micros, right? Just like that. If the stop loss is 50 points, you could do 5 micro. No, do 4. Do 4 micros with 50 point stop loss. And so remember, guys, this feature is in the website. So if you guys do want the formula, you do your drawdown divided by 5 losing trades in a row, and then you get that number, and then you try to find that number in the risk amount, and then you just play around with the contract size. All right, just like that. Very, very simple. All right. Let me see. Let me see. There you go. Anyways, someone say here, I've been loving doing five cons for the 50K. Dude, that works. Obviously, you're risking a little bit more, so you can probably afford to lose 4 trades in a row, but that's still pretty good, bro, to be honest. Anyways, all right, let's get back into the trade. All right, guys, so now that we found all of our 5-minute fair value gaps, which, wait, no, we haven't. One sec. We have one here, which the indicator did for us. Once again, everything here is automated, guys. Obviously, we've been on stream for quite a minute, so we should be finishing up very soon. Then we have one here, which is very small. I don't really think it's worth marking out anyways, so I'll just leave that be. This one has a drawn liquidity in the gap, so I'm not going to be using it anyways. And we have one here as well. Who's calling me? 8-day Daniel. I don't know who that is. Anyway, I'm sure you can wait it out. Anyways, okay. Wait. Daniel. Who's Daniel? Daniel. Let me hang up real quick. 8-day Daniel. Of course, the freaking number. Okay, right here. Have I ever texted this guy? Oh, him. Anyways, okay. So yeah, guys, now that we're finally done marking out all of our fair value gaps, we're pretty much all ready to go ahead and look into market open, so we can actually go ahead and start trading. All right, guys. So let me catch up with the chat before we do that. So let me turn off the indicator on the 5-minute. All righty. All right, perfect. Anyways, so let me see what we got here. I gotta get off now, Blast, but another great session. Hey, thank you. First of all, thank you for joining. Thank you for tuning in. It really means the world to me. And hopefully I was able to help you out. If not, I'll see you in the live trading stream tomorrow. All right, Lady Trades end up saying, I've been doing 2 to 3 micros in the 50K account for safety. That works too, but remember, these accounts are meant to be abused. These accounts are meant to be, traded. All right, so try not to do too little either, because the whole point of these accounts is, they're cheap and they're made to make money. All right, so try not to be too safe with them. In my opinion, do like 3 to 4 could work. But doing 2 on a 50K, that could be a little bit. That could take a little bit long, in my opinion. But hey, look, if it works for you, who am I to tell you it doesn't work? You know what I mean? So yeah, if it works for you, just stick to it. All right. Anyways, all right. So now that we're ready to finally come into market open, wait, let me mark out these highs up here. Actually, I completely forgot to mark out these highs. Okay. Yeah, we're pretty much ready. All right. So guys, now that we finally marked out all of our charts, we're finally ready. We're finally ready to see what we can trade today. All right, so let's look into market open. All right, guys. So first candle coming into market open, which was all the way over here. We actually ended up inversing this value gap, so it's no longer valid anymore. Anyways, the market opens up right next candle. All right, so now coming into market open, you guys know that typically I like to take my trades at around 9:30, 9:40, 9:50, 10 o'clock. Right, so anything before 9:30. Even if there's a setup, I typically don't really trade it. All right, so looking at the 925 candle, we're already inversing a 15-minute bearish valley gap. But since this trade was taken at a time that I don't typically trade, I kind of just skipped out on the setup. Although the setup was pretty good, now that I'm looking at it, to be honest, because it makes sense. Once again, if you look at the markets coming to market open here, right, we had our liquidity here at 29,068.50. We have a very bullish momentum, especially for a London session. And we saw the market has, really good buying pressure with room for higher. So looking at the setup coming to market open, it actually ended up playing out, if I'm not mistaken. Oh my goodness. Yeah, dude. Holy boner candle, dude. Oh my gosh. Anyways, yeah, dude. Yeah, this setup actually ended up working out quite well. Unfortunately, I wasn't really able to spot it in time because you guys know I start trading and I start streaming at 9:30. And this setup played out literally as the market opened up. All right, so yeah, I ended up missing out on this setup here. All right, but it doesn't mean that the setup was bad. So if you guys did end up trading today and you guys spotted the setup, really good work. Yeah, this setup was actually really, really nice, to be honest. Now that I'm looking at it. Once again, we had a pretty bullish momentum, really good buying pressure, a hold above the liquidity at 29,068. The next liquidity would have been at 29,173. We took out the liquidity, we held above it, still good buying pressure. We inversed not only the 5-minute, but the 15-minute bearish rally gap, and we insta-pumped straight into the price target. Like I said, unfortunately, I didn't take this trade because, once again, I don't trade before New York Open. Or typically, I don't, right? But yeah, really good setup. Anyways, let's see what else we got here. All right, so now that we are finally at market open, we can start finding some more setups that we can start using. All right, so coming into market open, guys, the first liquidity that we went ahead and took out during the New York session was the liquidity at 29,173. As we took out this liquidity up here, we also made a beautiful 5-minute bullish rally gap right over here. So we're going to go ahead and label this as the 5-minute bullish FEG. All right, now, coming into market open, what could be a possible trade or a possible game plan would be a possible sweep for a bearish bias off of 173 into an MSS model with lower highs and lower lows after we've created higher highs and higher lows, right? For the MSS model to look like this, into enough selling pressure to inverse this 5-minute bullish rally gap to look for some shorts off the inverse into the liquidity for lower. You replace your stop loss up here for about 73 points and have a positive risk reward at PT1 for over 137 points. Not too bad. All right. Now, unfortunately, although this setup looked literally amazing, we couldn't really take it because if you look at the market, it just continued pumping higher and higher. We tried getting a DOL sweep here, but unfortunately, as you guys see right here, we ended up pumping up even harder into the next level of liquidity. So now that we took out this level of liquidity at 29,239, I always tell you guys this one simple rule. All right, when you guys are finding your bias and when you guys are determining your bias in the markets, no matter how many levels of liquidity you've taken out during market open, you're always going to be using the liquidity that was the most recent one taken out. So right now, looking at the markets, I'm gonna ask you guys. All right, I'm gonna label this liquidity number 1, and I'm gonna be labeling this liquidity number 2 right up here. Right? If I were to ask you guys right now, looking at the chart, which one of these 2 levels of liquidities would you guys be basing your bias from, and why? All right, would it be liquidity number 1 because we took it out, or liquidity number 2 because we just tapped into it? Let me know your answer in the chat, guys. Let me know what you guys are thinking here. All right, once again, liquidity 1 down here and liquidity 2 up here. Which one do you guys think is the best one to currently base your bias from. Brian is saying number 2. Do you guys think otherwise, or do you guys think the same as Brian? You guys think it's 2? And Brian said it's the most recent DOL taken out. Now, Brian, you are and lady. Okay, ladies saying number 2. Anyone else? Let me know. Let me know. 2 as is the most recent. You guys are absolutely correct. Yes. All right, guys. So remember, when you guys are basing and when you guys are finding your bias based off a level of liquidity, it doesn't matter if we took out 100 levels of liquidity to the upside. It does not matter. Why? Because you're always going to be basing your bias off the most recent DOL taken out. And the most recent DOL taken out here would be the one up here, right? Because it's the most recent one, obviously. So now, if you guys even want to have a cleaner chart, what you could do is even delete this level. We're no longer going to be using it. It is no longer relevant to us. All right. So yeah. All right, guys. Now, let's see what more we got here. All right. So now that we're pumping up here, right? Obviously, once again, we do have a level. Wait, hold on. I'm getting a call here. Um. All right. Anyways, so as you guys see here, yeah, we have a fair value gap here, but unfortunately, we're nowhere near it, so we're probably not going to be using it at all. All right. So let's see what else we got here. All right. So now that we tapped into the liquidity at 29,239, let's see what reaction we actually get from this liquidity level. Right now, as you guys can see from the markets here, we are currently approaching a 5-minute bearish fair value gap. Now, let me ask you guys a little question here. Do you guys think that if we get a hold above this liquidity at 29,239, right, with good buying pressure, do you guys think it's a good idea to enter longs from this liquidity right here? I mean, from this fair value gap? Yes or no, and why? I remember PT1 is up here, right? Yes or no, and why? Let me see if you guys know the answer. Right? There are 2 answers to this question. Let me know, guys. Now, in the meantime, someone said here, I just took my first payout from Lucid. Thank you, Blast. 3 months into trading. Amazing, bro. Dude, if you could do me a favor, bro, if you can go in my server and go into the payouts channel, post your payout there, bro. I'll give you the payout role just like everyone else here. So everyone, if you're typing in the chat, bro, everyone knows you got a payout, bro. You got a little bit more respect in the chat. All right, and also I'll give you a shout out in the announcement channel. Anyways, so let me see your answers here. I'm actually pretty curious, all right? Because this is a pretty unique question. All right, let me see. So Bounty Hunter ended up saying, no, I would not take the trade because there is no MSS model. Raymond Garcia is saying no. B58 is saying yes. And Bounty Hunter is saying plus no DOL sweep from the lower liquidity. Right? M2 Spooky is saying no because the DOL sweeps are potential MSS models. Doug is saying DOL inside the fair value gap, so no. And Raymond is saying no because you might get stopped out because you just hit that liquidity. Now, you guys are, oh wait, there's one more. Brian Hernandez saying if there's a strong momentum and good MSS model to the upside, yes. But since there is a drawn liquidity and a fair value gap, there are 2 rejection points, so no. Brian, I absolutely love your answer, and this goes for everyone else. You guys are absolutely correct. Now, my answer to this is, check this out. All right, now remember, guys, a few seconds ago, I said there are 2 correct answers. You guys only got 1 correct answer, right? Answer number 2, as to why I would say no to inversion in this fair value gap, is because if you look at the next price target, which will be at 29,267, look at the price target. It's literally only 20 points. It is not worth taking. Right, and it's only 20 points considering the fact that you would have gotten a perfect entry, which we all know it probably wouldn't have happened. Right, because remember, with our model and with our rules, we always look and wait for an impulse above the fair value gap, which means we probably would have gotten an entry around like 250, 253, around there, which says that we're only going to get a 15-point price target. So with this trade, I considered it, but I'm like, nah, why would I take this with a 16-point price target? It just doesn't make sense. All right. So no. And by the way, guys, yes, you guys are absolutely correct. Another reason why I wouldn't take this trade is because we have 2 levels of liquidities inside of the fair value gap. So if price is very, very aggressive, chances are, bro, my cow was sleeping on the window and you're freaking stretched, bro. Anyways, so yes, guys. Even if we do have really good buying pressure, what could happen is with so much buying pressure, the market goes up more than it can handle, right? And then it will fake out your entry, and then it wants to sweep back down, stopping you out and giving you a bearish bias after you're in longs. All right, guys. So yes, you guys, once again, you guys are absolutely correct on your answer, right? There's a level of liquidity in the fair value gap. There's no MSS model. There's no confirmations, to go higher. I mean, if we break above the liquidity and we hold above it, yes, you can take it. But even if we did go above it, your price target would have been garbage. It just doesn't make sense. You're going to have like a 15-point price target with like a big stop loss, right? So it doesn't make sense to me, right? So with this setup, although it does look really good on paper, it's not the best to take on the actual trade, right? So yes, we're not gonna be using this for value gap. So instead, we're not gonna delete it just yet, because in fact, although this gap we're not gonna use it for an inverse, we could still possibly use it for a rejection point back down. Because check this out, guys, right? If the market takes out this liquidity at 29,239 and we reject off this fair value gap in which we rejected from 2 different times, we can actually reject and go back down into a potential inverse from this gap, or even this gap down here with the bearish bias, right? So let's see what we did off this liquidity. Off this liquidity here. So let's play the next candle. Next candle opens up and we go to the fair value gap, right? So obviously, right, this trade, obviously, we're not going to take a 15-point price target, and we didn't end up rejecting off a sweep. So now we no longer need this fair value gap, so we're going to delete it. And we also don't need this level of liquidity because we're currently basing our bias from the most recent one being right here. And we have another one here, right? We have a liquidity at 29,267. Now, guys, this is where things start getting interesting, because this is actually where we start actually entering our trade. All right. So let's see what we got here. All right. Now, looking at the 5-minute time frame, we saw that we pumped up quite a bit of points, allowing us to pump up over 87 points to the upside. All right. Let me see here. M2 is saying here, man, bounces are my weaknesses for real. I hate anticipating where the candle will bounce from a fair value gap. Yeah, bro. That's why I always tell you guys, wait for confirmations. Always wait for a specific point in a bounce so you know that buyers are really stepping in there. All right. So yeah, don't anticipate it. Just react with what you're seeing. So for example, if you're tracing into a bullish rally gap and we've already pumped up over 50 points, you know, it kind of shows that buyers are stepping in. You know what I mean? Buyers are probably there. You know what I mean? If we've already bounced over 50 points. All right. So I would definitely enter after a big bounce like that. All right. So yeah, try not to anticipate it. Just react with what you're seeing in the markets. All right. Anyways, so now that the market finally took out the next level of liquidity here at 29,267.75, not only did we take out level of liquidity, but right now at the moment, we are a little bit more bullish. Why are we bullish? Because we're holding above the level of liquidity. In fact, the most recent one taken out. But one key thing that we have here is another 5-minute fair value gap. Just like this, right? So obviously, if you measure the candle from top to bottom or bottom to top, it is over 87 points, more than what we need for a fair value gap. All right? So we're going to mark this out as a beautiful 5-minute bullish rally gap, right? And now, obviously, since we took our level of liquidity, if we can afford to get somewhat of a rejection or a sweep off of 267, we can potentially look to take shorts from this fair value gap right over here, right, off an inverse into lower liquidity here, here, and maybe even here, right? So 3 price targets, right? Not a bad looking trade. So let's see what we do in the next candle. Next candle opens up. We almost take out the liquidity at 285, but we didn't. If you really zoom in here, remember the markets. I told you guys yesterday in yesterday's class that the market is very specific. It's very precise. So although we got very, very close, in fact, 1 point away from taking out the liquidity at 29,285, we didn't take it out, right? So if we didn't take out this level of liquidity, we're going to be basing our bias from the most recent one, which is still going to be at 29,267. So what I'm going to go ahead and put here is hold below this DOL equals bearish bias. All right, guys. So obviously, if price is able to hold below this drawn liquidity after it's been taken out, not only does it confirm a sweep, but it also confirms your bearish bias. All right, so as long as price is able to hold below this, we are bearish. And if we're bearish, we're expecting for lower. And if we have a nearby bullish fair value gap and we're bearish, we're going to be looking to inverse this fair value gap. All right, guys. So let's see what we do in the next candle. All right, next candle opens up and whoa, look at that, guys. Very nice selling pressure. And if you look at the 1-minute time frame, you guys will see that we have a beautiful 1-minute MSS model right over here. So once again, the market is going from creating the main low, main high, higher highs, higher lows, higher highs, higher lows, higher highs. You get the point, right? Higher highs and higher lows constantly. So the trend is bullish, right? And why is the trend bullish? Because we have objectives above. But as the market continues going higher and higher up, right, you're going to notice that more and more liquidities are being taken out. And the more liquidities that are being taken out, this means that we have more of a chance in the market actually reversing. All right, guys. So now that we took out the objective, which is the liquidity at 267, if you could, obviously the MSS model will always start off on the 1-minute time frame, then the 5-minute, then the 15-minute, and then the 1 hour, and so on, right? It always starts off on the lower time frame, right? So if we're trying to snag ourselves a nice reversal trade into an inverse here, we want to be finding our market structure shift off the lower time frame, right? So if you look at the 1-minute time frame, we have our main high, main low, lower low, lower high, lower low, right? So here we can see that the trend, the structure of the market is shifting from bullish to bearish. Bullish because of a higher high and higher low, and bearish because of a lower high and lower low after the drawn liquidity sweep. Remember, guys, we only look for MSS models after a DOL sweep has been taken out. If it hasn't been taken out, don't look for the MSS. All right, so here, obviously, we have a 1 minute MSS model forming. All right. Now, as the 1 minute MSS model is forming and we are confirming ourselves to be bearish on the lower time frame off a DOL sweep, MSS model, and everything, and good selling pressure and good selling momentum, and we know that we have room for lower, we could potentially even look to inverse this 5 minute bullish valley gap. All right, so now we're pretty much ready. So yeah, let me go ahead and mark it out over here. Right now, this is how your typical trade should look like. Right, just like this. And also, don't forget about your VWAP. Let me turn it back on, just like that. All right. So this is how your normal trade should look like on a day-to-day basis. Now, if you look at my alert, you might be wondering, well, David, how come you didn't use the stop loss as the drawn liquidity? Well, I figured, I'm like, okay, well, instead of me putting my stop loss here at 267, right, what if I just place my stop loss at where we rejected from? It's not too far away, and it gives me a little bit more room in the trade to actually breathe and be able to afford a little bit more of a drawdown. All right. So instead of placing my stop loss where I usually would have placed it at 29,267, I told myself, I'm like, what if I just place it at the next drawn liquidity? It's right around the corner, and it'll give me more room to breathe in the trade. So instead of placing it here, I just place it at the rejection point at 29,284, which will actually come in handy today. All right. So here, instead of placing it at the drawn liquidity, I just place it up here, just like that. All right. 29,284. All right, guys. Now, you might be wondering, right? You might be thinking, okay, well, David, this trade looks like every other trade that we've taken that is considered a plus. So why did you say that today's trade was a little bit on the riskier end? Well, guys, let me see. Raymond said, let me see. I liked how we put our stop loss there. I'm gonna start doing that if I can. Remember, not every trade will be the same, right? Sometimes the stop loss will be 100 plus points away, which will be a pain in the ass. All right, so yeah, I would highly suggest doing it if it's any less than 70 points. All right. Now, you might be wondering, right? You might be thinking, well, David, this type of setup is a setup that we take every single day for years. And these setups are considered a plus. So why exactly did you consider this trade to be a little bit more riskier than others? And why did you size lighter? What did you see that we couldn't see that made us size lighter on this trade? Let me show you guys. All right. Now, on the 5 minute time frame, this setup looks literally perfect. Right, we have a good selling pressure, we have a good MSS model, we have a good sweep, we have a good bearish bias, we have room for lower. Everything looks amazing. All right, but check this out, guys. What do I always tell you guys that you need to pay attention to before you take an inverse off a trade? Make sure that there is no roadblocks. What do I mean by roadblocks? Well, if you're going to be taking an inverse on the 5 minute time frame, you best believe that you don't want anything stopping you out on the 15-minute time frame. Right? So if you look on over into the 15-minute time frame over here, you guys will see that we actually have in fact, a few bullish rally gaps. Right? So we have the 15-minute here, then we have another 15-minute here, and we have another 15-minute here. So we have three 15-minute bullish rally gaps stacked on top of each other, right? So why in the world would I take this trade? Well, in my opinion, I personally felt like, yes, although we had so many fair value gaps, in my opinion, I thought to myself, I'm like, instead of me waiting for the market to sweep the liquidity and dump down below 29,267 and wait over 200 points to get an entry, what if I just anticipate one fair value gap inverse and just target the rest of the fair value gaps? Right? I feel like it'll be way easier. Right? Obviously, this makes the trade riskier because if the market retraces into this 15-minute and we bounce, we could be in some trouble. But if I'm already bearish and everything is confirmed for lower, why don't I just inverse the 5 minute fair value gap here, right here, and just anticipate, hey, if we inverse the 5 minute, why can't we inverse the 15-minute? It just, it made sense to me. So obviously, this doesn't mean that the trade was perfect, but it doesn't mean that the trade was bad. All right. So in my opinion, although this trade, in my opinion, was pretty good, it's not perfect, which is why I personally consider this trade a little bit riskier than normal, right? Because once again, we are taking an inverse, as you guys see right here. Right here, we are taking an inverse right, wait. Oh, wait. Where was it? Right here. Right, although wait. Sorry, guys, one sec. right there. Although we did get the inverse off the 5-minute bullish rally gap, right, with the bearish bias, 1-minute MSS, good selling pressure, good momentum, good room for lower and everything, right? Although it looks good, if you look at the 15-minute time frame, we're still inside of a 15-minute bullish rally gap, which could be trouble. But once again, the reason I took this short, which I don't really highly suggest all the time, is because once again, the 15-minute rally gap could have given us a little bit of trouble after the retracement. All right. But the thing is it's either you wait for a 200-point dump to take shorts, which can make the market oversold by the time you enter, or you enter a little bit earlier and you just take the risk of a possible fair value gap bounce. To me, I thought it was going to be a lot easier to trade off the 5-minute inverse instead of waiting for every single of the 3 fair value gaps on the 15-minute time frame to get inversed. Right, which once again, I told you guys, it makes the trade riskier. It doesn't make the trade bad, it just makes it a little bit riskier than normal. So although this trade wasn't, on paper, it was an A+ setup, it wasn't. All right. In my opinion, I would say the setup was like a good B setup. All right. So we ended up entering this trade off here. We went straight into the 15-minute gap right here, as you guys see right there. And obviously, expecting the 15-minute gap, we got a few bounces, which is where this next bounce came from. Right over here. Right here. Right. We ended up getting a bounce here. Now, to the normal person, which, to the normal person, if you go here, people see the pullback and they automatically assume the worst. They think that the trade is over, the trade is cooked, and we are getting stopped out. But no, guys. In fact, if you tune into today's stream, I actually told you guys that we needed to see a little bit of drawdown in the trade. It was going to be normal. Obviously, hopefully not enough drawdown to get us stopped out, but we needed enough drawdown in the trade to confirm the MSS model. Because at the moment, guys, if you pay attention, the only thing that we have here is the 1-minute market structure shift. But we needed the 5-minute. So instead of marking out the 1 minute, now we officially have the 5-minute MSS model, which is even better. So the fact that we got a pullback, we didn't break past the previous candle high, we rejected this candle from green to red, and we confirmed the MSS model, we're good to go. But are we completed? Are we like ready to go lower? Not quite. All right, guys. So even though at the moment, and pay attention, guys, it's gonna be very important. All right, you guys need to know this. All right. Even though the market just created the main high and lower high up here, right? Have we created the lower low to confirm the bearish bias? The bearish trend on the lower time frame? No, we have not. All right. Once again, guys, we have the main high, lower high. We have the main low, but do we have the lower low? Not yet. So although this trade was currently sitting a little bit green, I told everyone, do not get too excited just yet. Don't get excited until we break past this previous candle low. Once we break past this previous candle low, we should see the price target. Now, here's where the market got a little bit choppy. Now, if you were to ask me why the market got choppy, I unfortunately do not have the answer. In fact, I don't think anyone has the answer. No one knows why the market chops. All right, so as we were holding this trade, unfortunately, we got a little bit of this, and a little bit of that, and a little bit of this, and a little bit of chop, and a little bit of chop, a little bit more chop, a little bit more chop, and a little bit more chop. Well, actually, I think we dumped here. Yeah, okay. Anyways, so yeah, now, as we are chopping here to the normal person, right, you guys would imagine, oh my gosh, the trade is terrible, like, fuck, like, I don't want to be chopping out, whatever. But on the back end of the trade, if you guys really pay attention here, in fact, let me ask you guys, what do you guys think is happening here? Although we haven't made any lower lows and we're chopping, why is this trade still in our favor? Let me know if you guys are in the chat. I'm going to give you guys a few seconds. Let me know. And you guys can be wrong. All right, let me see. Wizard Space, I have to go now, but thank you for the stream. I got you, bro. I'll see you in the live stream tomorrow. All right, but anyways, for anyone else tuning in, right? What do you guys think is going good here in this trade? Right? Once again, we're very choppy and we haven't created the lower low, but what are we creating as we go lower into our price target? Rejection wicks. What are they known as, though? Yes, you're right. You're right. Yes, rejection wicks. But what are these known as? VWAP magnet? You're there, right? Yes, the VWAP is the price target. Right? There you go. There's the answer I wanted to see. Raymond Garcia. Because our highs aren't getting higher. We are constantly creating lower lows. Right? So what does this confirm? Well, the MSS model is forming, but it's not fully formed. Right? It's not going to be formed until we break past the previous candle low, which will be at 195. But in the meantime, we have our main high, lower high, lower high, lower high, and lower high. So I don't know if you guys were noticing this while we were in the trade today, but as the market kept trying to pull back over and over and over, we constantly kept creating lower highs. And although this looks a little bit ugly, which I will admit, yeah, this is a very ugly market, it's still very, very bearish. right? So we have a DOL sweep, good selling pressure, main high, lower high, lower high, lower high, lower high, which confirms the MSS model. We still have room for lower, and we're still respecting the inverse. So now, as long as we're able, and I told you guys on stream today, once we are able to break below 195, we should be able to see at least one price target. And that's exactly what we saw right here, right? Resulting in a beautiful, no, I wouldn't say beautiful, but I would say it resulted in a pretty good 45-point trade, resulting in some beautiful profits being made right over here, as you guys can see right here, right? So yes, we hit PT1, we scaled out, and then obviously with the market being so choppy, obviously, the trade kind of chopped out back into a break-even stop loss, which would have gotten you stopped out in the green. All right, so not a bad trade at all. All right, so this sums up our trade for the day. Now, are we done with the stream? No, almost. All right, we have a few questions, and we also need to journal our trade down. So let's get into doing this. All right. So before I start journaling this down, since I already reviewed the trade with you guys, let's put it all on paper. All right, now, BZ, I think that's what you say. Okay, wait. Underground, David, it's Aaron, bro. Can you explain that legacy accounts, mate? I'm just looking at the website right now. Answer when you can. Don't go off topic yet. Now, don't worry. Okay, so look, for anyone that wants to get the legacy accounts, in my opinion, they're really really good. The difference between those rules and the other rules of the new accounts is the legacy accounts doesn't have a 6 payout limit per account. They don't have a daily loss limit. They have more drawdown. I think they have a better consistency rule, and they're overall just better. I believe they're better. So yeah, they're really really good. They're really really good in my opinion. Yo, Blast. Wait. No. Let me see. I wanted to ask you about determining your bias between the New York session and the Asia break. Like, if we sweep at drawn liquidity at the end of the New York session, does that determine the bias also for when Asia opens, or do we need another drawn liquidity? Well, you can use the New York session bias into Asia, but it would be a lot more fresh and a lot cleaner if you take out a drawn liquidity during Asia, I would say. But either or works. Either or works. Bounty Hunter is asking, yo, Blast, I feel like I have a good grasp of the strategy, but do you have any experience with revenge trading off losses and overall just gambling while trying to hit targets? If so, how do you get over it? Well, for me, I don't feel like I really revenge trade all that often. And if I do end up revenge trading, I do it correctly. Like, I always wait for a setup to come around, and I will admit, yes, I've taken setups where it's like, dude, like, what are you trading? Right? Even though there's a setup there, maybe the volume sucks or whatever, I don't agree with it, right? But the best way to go about revenge trading, if you feel like you can't hold yourself back and you feel like you're clicking the button, lock yourself out. Most prop firms and most brokers like Tradeovate, TopStepX, and so on, they all have a lockout feature. It's there for a reason. Use it. If you feel like you can't hold yourself, once you take a certain amount of losses, lock yourself out. Press the button. Press the button. All right, bro. So yeah, that's the best way to go about it, and it builds a really good habit. All right. Let me see. Do you recommend using the VWAP indicator? If so, is the indicator just called VWAP? Yes, I highly suggest using the VWAP indicator. In fact, I use it myself. And the way you find it is you go to Trading View, click on Indicators, search it up, and search up VWAP, and it'll be the first one called Volume Weighted Average Price. This is the one that I use. All right. Let me see. They sound better. I do, trust me, they are better. I'll DM you as I'm hoping to get off soon. I'm shattered. All right, bet I got you, bro. Don't even worry about it, dude. I got you. Apex on Tradeovate doesn't let you lock out. I think it does. You just have to set it up in the settings. I could do a stream on it. Like tomorrow maybe. Anyways, so now that we're done reviewing the trade, let's actually write this down so we can actually finish up the trade. Thank you, David, baby. Yo, what the heck? Yo, I got you, bro. Anyways, so yeah, let's write this down here. All right, so pre-trade conviction. In my opinion, before we enter this trade, I feel like this trade was a solid, I would say like an 8 out of 10, right? Obviously, it could have been better. The 15-minute, we could have inversed it. There's a lot more 15 minutes to the downside. So as much as I want to give this trade a 10 out of 10 on the 5-minute time frame, we need to consider the 15-minute time frame as well. And we all saw the 15-minute time frame had 3 bullish rally gaps. So I'm going to rate this trade a nice 8 out of 10, before we entered. Right now, my emotions before this entry, I would say I was pretty focused, right? I want to say I was focused mainly because, well, I would say I was a little bit more hopeful because once again, we were entering the trade of the 5-minute and we were hoping for the 15-minute to get inversed, which was a little bit of a bad habit, right? So instead of saying I was focused on the trade, I would say I was a little bit more hopeful. Now, my emotions after the trade, I would say, I'll a little bit more anxious, just because obviously the market was so choppy. Obviously, as long we still had the lower lows and lower highs being created in the MSS model, but with the market being a little bit choppy, it does make you a little bit more anxious. So yes, I would say a little bit more anxious. Now, did we follow our game plan all the way? Absolutely, yes, we did. Right, and the reason I'm saying we did is because we waited for the DOL to get taken out. We waited for the DOL sweep. We waited for our MSS model. We waited for the inverse, and we knew that we had room for lower, right? And with our room for lower, we used that as our price targets, and we took profits as we hit those price targets. So yes, we did fully follow our game plan. All right. Now, what else do we have here? Now, in terms of mistakes, let's see what we're doing, right? So our journal is telling us that what we're doing right. IFG strategy is your edge. You have over a 91% win rate, right, with a 1.5 total R over 11 trades taken. Take this one with confidence. The data says it works, right? So our journal is telling us that anytime that we take an inverse value gap trade, it usually tends to work out with the rules that we use. All right, so that's a very good thing. Now, 5 plans followed in a row. You're struck to the playbook with your last few entries. Keep the chain alive, keep the streak alive, and this pretty much means that we're following our game plan. Now, before we move on any lower, we need to check out all of our rules. We need to make sure that everything here is lined up. Now, before I do that, let me ask you this question. Hey, Blas, quick question. With the current market, I see a 30-minute bearish rally gap above and a 1 minute, 1 hour bearish rally gap. That's over 40 points away from each other. What does one do in this scenario? You wait for both rally gaps to get inversed. Yeah, you okay, look, if you don't really care about the points and you have a really good risk reward in terms of stop loss, you can inverse the 30-minute and wait and target the 1 hour entry for 40 points. But if you don't want to do that and you have a higher stop loss and you want a better risk reward, you can just wait for both the 30-minute and the 1 hour to get inversed. And then you take the entry into the John liquidity. Hi, David. Would you consider setting a weekly or bi-weekly call with cameras on to help boost a sense of community? Wait. With cameras on, like a Zoom call with you guys? Is that what you guys are asking? To help boost a sense of community amongst members. Training can be a hard, lonely journey, and I agree with you. Yes, it is very lonely. But what do you mean in terms of cameras? Like cameras, like my camera on or your guys' cameras on? All right. Anyways, let me see. Yes, I mean, yeah, we could try. I mean, it's a little bit more work. I would have to see how I can set it up. But yeah, I'll be down for that, low key. Yo, I posted the payout. Yo, good shit, bro. Let me give you that roll, bro. Good stuff, dude. I'm very proud of you, bro. Like seriously. There you go. Anyways, I think that you answered this question already, but is there free access to the website with the premium purchase? We're still thinking about doing that. But for now there is a free trial. So if you want to give it a shot, just click the link below, which I'll send it once again right over here, and sign up to the website. It's a 14-day free trial. Give it a shot, and we go from there. Someone say here, shit, I wouldn't mind blast Q face in a Zoom call. All right, bro. Anyways, let's finish this up. So looking back at this trade, guys, once again, did we follow out of our rules with this trade? Right. First rule with our strategy being this did price sweep liquidity. Yes, it did. Right. Obviously, we took out the liquidity at 29,267 with a good sweep plus MSS model, which leads us into the next question. Did we have the MSS model? Yes, we did. Did price have strong aggression and momentum into the inverse? Yes, it did. Right over here. Right. We had a beautiful 56-point dump. Right. Yes, we did. Did price inverse the fair value with aggression and volume? Yes, we did. Right over here. Right. So if you go back to this candle, you go back to the 1 minute, you can see that we had a nice impulse to the downside for over 45 points. Yes, we did. Right. And did we have room for lower below? Absolutely. We had PT1 at the VWAP, PT2 here, PT3 here, and PT4 here. Right. So yes, we did have room for lower. So this trade so far, we are respecting all of our rules. So once again, guys, even though this trade looked very, very choppy, and it was choppy and everything, this setup in my eyes was still pretty decent. I'm not gonna say pretty good, pretty decent, right? Obviously because of the 15-minute fair value gaps, right? So yeah. Anyways, let's see here. So now, did we make any mistakes with this trade? Did we get a late entry? No, I feel like we actually got a pretty good entry. Did we get an early entry? Yes, we did. Right? And what I said, yes, we did, because remember, guys, we inversed a 5-minute, but we were still inside of a 15-minute fair value gap in which we were trying to anticipate, which could have made this trade a lot riskier. All right. Now, did we miss our entry? No. Did we get a bad fill? No. Did we move our stop loss in terms of emotions? No, we didn't. Did we place no stop loss? Nope, we placed a stop loss. Did we hold on for too long? Nope, we took profits at the price target. Did we cut the winner short? Nope. We held all the way into the price target. Did we chase price? No. Did we go against the trend? Nope. And did we use the wrong size? Nope. Mindset. Did we have any FOMO? No, we didn't. Did we revenge trade? Nope. Did we hesitate? Nope. Did we tilt? No. Were we bored? Nope. Were we overconfident? Yeah, we kind of were. And the reason I'm saying we were a little bit overconfident, guys, is because once again, we were confident in price inversing every fair value gap lower, which is why we got an early entry. All right, so we need to type this down here. Were we hoping for a trade? Yes. Were we I can't even speak. Did we have fear behind the trade? No. And were we greedy? No. Discipline. Did we over leverage? No, we actually under leveraged. We traded with proper risk, right? 5 micros. Did we have no plan? Nope, we had a plan. Did we skip the checklist? Nope, we actually checked out everything here. Did we trade during news? Nope. Did we trade outside of the New York session? Nope. Did we overtrade? Nope. Did we break our day loss limit? Nope. Once again, we undersized. And did we ignore our A+ filter? Nope. All right. Do you recommend using TradingView for charting and brokers like TradingView for actual entries? Yes, absolutely. TradingView is not a broker. So it gives, you can use it to trade, but it will give you some very delayed entries. So yeah, don't do that. Don't do that. Anyways, so let's review our mistakes here. So how costly was our early entry? To be honest, it could have been moderate. You know what I mean? It could have been pretty costly. Hold on. Oh my goodness. Sorry for that, guys. I had to sneeze. Anyways, so for our early entry, I would say it was a pretty moderate type of thing, right? I feel like we knew what we were doing when we were entering early, but it was not the safest thing to do ever, right? So 1 second, what would I do differently next time? So for next time, I want to say here, make sure that we are entering after every FEG is inverse. Trying to anticipate the market can make this trade more risky. All right, now for overconfidence, honestly I would say moderate again. And the reason I'm saying the overconfidence was a little bit more moderate is because once again, what would I do differently? I would say instead of entering from off a 5-minute IFEG, right? When there's a 15-minute IFEG or FEG lower, I need to stop, or I don't need to stop. Like, it's not a good thing that I do it, but obviously you can manage it. You know what I mean? It's definitely manageable. So I need to stop anticipating the 15-minute IFEG after the 5-minute IFEG. Wait for both. Right, wait for both to get inversed, right? Because obviously it will give us the best entry, and it will like get rid of the roadblocks. You know what I mean? Like, you know what I mean? Like we don't want that. You know what I mean? We don't want those bumps in the road. So when we're taking the trade, we need to make sure that we're inversing everything. So when we take the trade, it's only our entry and our price targets. There's nothing in between. All right. Now for the hopeful trade, how costly was this? I would say moderate again. Right. Now, what triggered this hopeful trade? Right. Refused to take the loss? No. Like we had our stop loss placed. Did we believe that the bottom was in? Yeah, I mean, yeah, we'll say that the bottom was in, or the top was in. The top was in. We took shorts, right? I believe that the market was bound to reverse, and I didn't want to wait for a 200-point dump. So instead of waiting for the market to dump over 200 points for just an entry, not even a price target, I would much rather just, I would prefer to enter earlier with more risk, which could be a pretty bad habit. All right, so what I will do differently behind this trade is make sure that I don't anticipate the IFEGs before they happen. Although this trade worked out, this can put me in a bad spot. Bad spot where I can't type. Yeah, a bad spot where I can get stopped out. Even though we inverse a 5-minute, we can bounce off the 15-minute. All right. And repeatedly, what would I do differently this time? This is actually something that I've done before. This is a mistake that I keep doing. Right. So what I could do here is what I'll do next time is, if there are multiple FEGs stacked on top of each other, instead of entering off the first IFEG and anticipate we head lower into the other IFGs. Just wait for everything to get inversed. There you go. Before entering, I'm gonna put enter because I can't type everything. All right, anyways, for the wins, let's see what we did here before we actually end our journal. All right, for the wins, let's see what we did right. All right, guys. So we definitely followed our plan. We got a pretty good. I'm not gonna say patient entry. Yeah, I'm gonna remove that. We had a really good stop loss. I love the stop loss, so I would say that we didn't hold any runners because I wanted to get out of this trade as soon as possible due to the chop. We trusted. We probably trusted the setup a little bit too much. I'm not gonna put we trusted the setup, to be honest, because we were a little bit doubtful once we saw that ES and NQ were bouncing off the VWAP and the 15-minute drawn liquidity. All right, so I'm not gonna put we trusted the setup. Well, we did because we did enter earlier and we did anticipate it. So yeah, I'll put we trusted the setup. Did we cut quickly? No. Was an A+ setup? No. And did we scale in? I don't personally scale in. Like, I don't trade like that. Now, what does this trade teach the future you? Make sure this trade definitely teaches the future me. Let me tell you guys. Make sure that when you're taking an IFG trade, make sure that that the market has inversed every nearby DOL. All right. So the next target is the DOL. There you go. Now, any notes for this trade? To be honest, the notes, it's all in the stream, right? So I can just use the stream as the notes, right? So I'll just like freaking link this. There you go. Anyways, now for the chart screenshots, let me go ahead and link over the chart screenshots, right? So if you go down here, we entered right over here. So we took the trade on the 5-minute time frame, and then we exited right over here. Boom. Just like that. And just like that, guys, we are officially done with our journal. It took us 2 hours. We have been trading for freaking 2 hours, guys. Oh, wait, right here. Hold on. This trade breaks one of your rules. Whoa, okay. The trade score is 58, and it's below. You say, oh, this is like an hold on. I already took this trade. Ignore the trade score. Yeah, I was about to say that. Go ahead. Anyways, all right, there you go, guys. So there's another trade that we ended up taking. It's rated a B setup, right? So it's not an A+ setup. It's not an A setup. It's not a bad setup either, but we definitely did make some mistakes, and this trade could have been a lot better. All right, guys. But yeah, that pretty much makes up for my journal for today, guys. Once again, my P&L, or the trade that we took today, was a 40-point trade into the VWAP. My P&L was we caught 40 points, and my P&L was a $3,000 P&L. Right, which I ended up making over $3,110, or pretty much $311 per account, times 10 accounts being copy traded. And yeah, guys, that pretty much makes up for the what's it called? That pretty much makes up for the I lost my train of thought. That pretty much makes up for the journal stream, guys. I'm so sorry for that. I lost my train of thought. But yeah, guys, hopefully you guys were able to enjoy the stream. Hopefully you guys were able to learn something new, guys. And once again, I will not be live trading Asia tonight, guys, or I won't be trading Asia at all tonight. My friends are going out, and I low-key have been at home all day today, so I'm pretty exhausted from the charts. So I'm gonna go ahead and disconnect a little bit. All right, guys. I've been doing way too much work today. All right, guys. So once again, I'll be live streaming tomorrow at 9:30 a.m. EST. Once again, I really hope you guys learned a thing or two from today's stream. And if you did, let's apply that knowledge to tomorrow's live trading so we can make some more money. All right, guys. So yeah, hopefully you guys enjoy the stream, and I'll see you guys very, very soon. All right, guys. Peace, guys. Enjoy, guys. Peace.